Okay. Good day, audience. Can you hear me, please, so that we can start our session formally? Okay. Today is the first day of our practice to pass session of F7, right? Okay. The objective of this session is to revise things which you have studied. Please don't expect that we'll do each and everything, but we'll try to cover major important areas, right? Okay. Now let me introduce myself. My name is Mustafa Mirchawala. I'm the CEO of Mirchawala's Hub of Accountancy, Institute of ACCA, ICAEW, CFA, and all these qualifications, right? I've been teaching for last almost 16 to 17 years. My major papers are F3, F7, F6, SBR, and corporate reporting of ICAEW, that final paper, right? Okay. I'm also a vlogger. Sometimes I make development videos for students as well. And our students, our institutes offer everything, all complete ACCA courses, right? Okay. Now, and Alhamdulillah, recently my students got 3 positions, 2 in Saudi Arab, in one F6 Saudi top, the second is SBR Saudi top, and the third one Pakistan nationwide position in F6, right? Okay, so let's start. And today's day's objective is consolidation. Today we are going to cover consolidation, right? Okay, so what's the strategy? First of all, first 1 hour or 1.5 hours, I'll be giving you some recap of consolidation, what you have studied in the class, and then we'll shift to the question. And obviously, we'll be doing questions on Excel or software, right? Now, first of all, we know, can you see the screen? We all know this is very basic. When one company acquires 50% plus ordinary shares of another company, when one company acquires 50% plus ordinary shares of other company, that company gets the control of that company, right? Okay, now this control means parent company is buying running business. Always think like that, that parent company is buying running business of subsidiary company, right? Okay, now first of all, we are doing the SOFP thing. In consolidated SOFP question, what's the first step? The first step is you have to make net assets packet. You have to make net assets packet. You can see on the screen, there is one date. This is 1st of January. This is 1st of January 2016. And the second date is 31st December 2017. This date is acquisition date. This date is acquisition date. Acquisition date means the date on which parent company acquired subsidiary company. Parent company acquired subsidiary company. So first of all, my dear students, first of all, you need to make net assets packet of S company. Net assets packet of S company, right? Okay. Look at here. So for example, you have share capital at the acquisition date of S company of 10,000, share premium 5,000, retained earning 10,000. These things are normally ready-made given in the question, right? So you'll just copy paste it. That's it. Now, this is reporting date. The reporting date is the date on which you have to prepare SOFP. Reporting date is the date on which you have to prepare SOFP, right? So at the SOFP date, you have share capital of 10,000, share premium of 5,000, and the retained earning number is 30,000. Now look at the screen and think over it. You know that even in your basic papers you studied about this, that this is the scope of our course, that once parent company has taken over S company, from that date S company won't issue any new shares. From that date, S company won't issue any new shares, right? That means there in your course, never ever, there will be no change in share capital and share premium. No change in share capital and share premium of S company after the takeover date. Yes, but retained earning may be changed. Retained earning will be changed. Okay. So now, acquisition date net asset packet is 25,000 and reporting date net asset packet is 45,000. And the difference between these two packets is your S company's post retained earning. This is called S company's post retained earning or S company's post net assets. Okay. Now, what we do, there are 2 methods of consolidation. You have studied this in your with your teachers that there are two methods of consolidation now after 2008. After 2008, first method is proportionate method. First method is proportionate method. What do you mean by proportionate method? For example, parent company is acquiring 80% shares of S company. Parent company has just acquired 80% shares of S company. So now if we are using proportionate method, then we'll calculate proportionate goodwill. Means we'll only calculate 80% goodwill. We will only calculate 80% goodwill. Now what's the formula of goodwill? See, look at the screen. Look, I've just enlarged it. Cost of investment means whatever parent company price parent company has paid. Cost of investment less fair value of net assets of S company. Now which date? Now the question is, which date do we compute goodwill? We always compute goodwill at acquisition date. We always compute goodwill at acquisition date. That's why we always use acquisition date net asset packet in the computation of goodwill. Look at here. So now cost of investment, obviously we have acquired 80% shares of S company, so this cost of investment is equal to 80%. So definitely we have to multiply the net assets of S company. We have to multiply the net assets of S company with 80%. So now just think, this COI is also 80%. My dear student, this COI is also 80%. This net asset packet is also 80%. So obviously the goodwill is also 80%. This goodwill is 80%. Okay, so this is the first characteristic of proportionate method, that whatever percentage holding you have, you will compute goodwill to that extent only. You will compute goodwill to that extent only. Okay, then second thing, how to calculate NCI. NCI means minority shareholders. We are controlling party, the other party is non-controlling party, right? Now in this proportionate method, open your eyes, in this proportionate method you will compute NCI proportionately. What do you mean by proportionately? Means S company's net assets multiplied by the NCI holding percentage. Very simple formula. S company's net asset multiplied by NCI holding percentage. Now on the screen I have used a detailed method. There is a shortcut for this as well. What I did, first I took S company's acquisition date net assets. First I took S company's acquisition date net asset multiplied by 20%, and then I added this S company's post retain earning. Then I added this S company's post retain earning. Then I added this S company's post retain earnings share of S company in this. So automatically this is NCI at reporting date. Automatically we get NCI at reporting date. But we have a shortcut as well for this. Sir, what is the shortcut? You can directly pick up this packet. Look at here. You can directly pick up S company's reporting date net assets packet and just multiply it by 20%. Just multiply it by 20%. Okay. Now the third thing is consolidated reserve. Reserve means group retained earning. Consolidated reserve means group retained earning. What are normally the major components of consolidated reserve? Definitely parent company's complete retained earning at the reporting date, parent company's complete retained earning at reporting date, plus S companies post retained earnings times your holding percentage, plus S companies, look at the screen, plus S companies post retained earning times 80%. That means S companies post net assets, S companies post retained earning goes to at two places, 80% in consolidated reserve and 20% in NCI, because right now I have assumed the holding 80-20. Right now I have assumed the holding 80-20. I have assumed the holding 80-20, right? So look at here. This is what your proportionate method is. Goodwill is calculated up to your holding percentage extent. Means if you have 80% holding, then goodwill is only computed till 80%. That's it. NCI in proportionate method, NCI, how we compute NCI? Come on, speak. How we compute NCI in proportionate method? S company's net assets packet, simple formula. S company's net assets multiplied by NCI holding percentage. S company's net assets multiplied by NCI holding percentage. S company's net assets multiply by NCI holding percentage. Okay. Now, there is one more method which we call, and that's very famous method. Even in F3, you there is only one. This method is only examinable in F3 paper, but in F7 we have two methods. So this method is full goodwill method. What's the special thing about full goodwill method? The special thing about full goodwill method is we my dear student, look at here, we record complete 100% goodwill. We compute and record complete 100% goodwill in full goodwill method. Okay, this is the first characteristic, don't forget. Now, what's the formula? See, this is the formula. Look at here, I've just enlarged it so that you can watch it clearly. Listen, first of all, you will write cost of investment. Obviously, let's assume you have bought 80% shares of S company. So obviously cost of investment is 80%. So this is 80% cost of investment. Now we are one owners. We are at one side, we are standing, and the other side, NCI is also the owner of S company. NCI is also the owner of S company, and now we need to compute 100% goodwill. So definitely we'll add this thing, fair value of NCI at acquisition. Fair value of NCI at acquisition. And my dear student, in 90% or 80% questions, this fair value of NCI is ready-made given. This fair value of NCI is ready-made given, okay, right? So, and sometimes, let me make it clear. And sometimes you need to compute this fair value of NCI. Sometimes you need to compute this fair value of NCI through S company's NCI's number of shares multiplied by share price. NCI's number of shares multiplied by share price, right? Okay. Sometimes, let me do one announcement. Our admin has shared a WhatsApp group link in the chat box. You can see, you all should join, because from tomorrow's we'll give you class ID through this WhatsApp group. Okay, so must join this WhatsApp group. So you will be given many more information through this WhatsApp group. Okay, be active. So now COI is 80%, 20% is the fair value of NCI. This gives you total 100%. This gives you total 100%. Now, then subtract fair value of net assets of S company. Now, this fair value of S net assets is also 100%. So automatically, this goodwill is also 100%. So the first difference between proportionate method and full goodwill method is, in proportionate method only 80% goodwill is recorded. In full goodwill method, complete 100% goodwill is recorded, right? This is the first difference, the goodwill. And there is one more difference, and that is NCI. Listen my lines very carefully. In full goodwill method, NCI is reported at fair value. In full goodwill method, NCI is reported at fair value. NCI is reported at fair value. And this fair value is already given in the question. And this fair value you have already used in goodwill calculation. So now what you do, you will write this fair value of NCI at acquisition date, but don't forget that this fair value of NCI, fair value is given at acquisition date, but you are preparing balance sheet at SOFP date. So you need to adjust S companies post retained earnings share in this. You need to adjust S companies post retained earnings share in it. Okay, so that's how you calculate NCI. And obviously I expect good from you, that you guys must know these all. Just I'm giving you a quick recap. Okay, and in this method and proportionate method, consolidated reserve working is copy paste same. Either you are using proportionate method or full goodwill method, consolidated reserve working is total same, no change at all. Okay, so now the next topic. Before we move to the next topic, I'm giving you one more basic thing. I'm teaching you one more basic thing. Let me tell you one thing very clear. There are different methods of teaching consolidation, different style of teaching consolidation. Some teachers teaches through double entry. some teacher teaches through BPP style, BPP kit style, and some teacher teaches through net asset style. I have taught in all these three styles in last 15 years, but I found more easy to pick, more time saving style, and that is net asset style. Okay, so that's why I am following net asset approach. I am following net asset approach. Okay, now listen, this is very routine that each and every time, look at here, each and every time you will make, let me change it, each and every time you will make net assets packet. This is very routine. Acquisition date net asset and reporting date net asset packet. Acquisition date net asset and reporting date net asset. Look at here. So how much is the acquisition date this time? 20,000. Boys and girls, please be very active. Be very active and listen each and every word very carefully so that your journey goes very smooth. Now acquisition date is 20,000, reporting date is 50,000. So definitely the post S company's post retain earning is 30,000. Now let me teach you some basic mathematical thing, maths. For example, there is 1,000 expense which S company forgot to record. There is 1,000 expense which S company forgot to record. So now that expense we should deduct that expense from S company's post profits. So this will make S company post profit as 29,000. This will make S company's post profit as 29,000. Look at here. Repeat. S company forgot to write 1,000 expense in the P&L of S company. So definitely the profits are overstated. So now we need to adjust the post profit. So we just adjusted this expense, and then after the adjustment, the S company's post retain earning came out to be 29,000. Now wait. I can do this. I can get this 29,000 through one more approach. There is one more approach. No need. Listen. No need to subtract this 1,000 from S company's post retain earning. Just do one thing. Look at here. Do one thing. Subtract this 1,000. Subtract this 1,000 from reporting date net assets packet. Subtract this 1,000 from reporting date net assets packet. See, you will get the same result. So now what's the reporting date packets total? 10 plus 40 is 50 minus 1. 50 minus 1 is 49. Look at here. 50 minus 1 is 49, and now 49 minus 20 is 29. See, the same effect is in S company's post retain earning. The same effect in S company's post retain earning. Yes or no? Yes or no? So from now onwards, what we'll do, open your eyes and ears. What we'll do, whatever we need to adjust in S company's post profits, whatever we need to adjust in S company's post profits or post retain earning, just adjust the same thing in the closing reporting date net asset packet. You will get the same result. Okay, don't forget it. You will get the same result. You just saw it. Now these are very simple transaction, P to S and S to P. Even you have studied this in your F3 paper and F7 as well. So first of all, P to S and S to P sale of inventory. We all know that inventory is sold for resale. So the profit of inventory is realized when goods are actually sold. And when if the goods are not sold by the year end, if the goods are not sold by the year end, then that profit is unrealized. Okay, so look at here. First of all, on the screen you can see, we can't waste time on basic things, okay, but I'll just give you a quick recap. You can see there is a P2S sale. P company bought some goods for 200 and sold to S company for 500. That means parent company has booked 300 profit. But unfortunately, S company has not sold these goods to third party. has not sold to has not sold these goods to third party by the year end. So from the group point of view, this profit is unrealized. This profit is unrealized. Okay, so now we need to remove this unrealized profit from group accounts. Now how we'll do it? Just think it, you'll do it as this transaction is P2S. As this transaction is P2S, that means this unrealized profit is booked by parent company. That means this unrealized profit is booked by parent company. So it must be in parent company's P&L, and through parent company P&L, it goes in P company's retained earning. So now it is present in parent company's P company's retained earning. So now you need to remove from parent company's retained earning. And when you remove something from parent company's retained earning, automatically CR will be hit. So what we do, whenever we do P2S sale, we remove URP, unrealized profit, from consolidated reserve. This is the first step. And the second step, when P company has sold expensive goods to S company, that means year end S company's inventory is also overstated. So you need to remove URP from inventory as well, from group inventory as well. Don't forget this thing. Okay, so read this step. This is the P2S sale step. Quick, please. Now, for S to P, look at here. For S to P sale, if S company has sold goods to P company and P company has not sold goods to outside the group by year end, so definitely now the URP, now the unrealized profit is booked by S company. So URP is included. URP is included in S company's profits. So obviously URP is included in S company's post retained earning. Now look at here. So the student will say, sir, yes, we need to remove it. We need to remove URP from S company's post retained earning. Yes, that's right. But as I told you before 5 minutes, that whatever you need to deduct from S company's post retained earning, just simply deduct the same. From S company's reporting date net asset packet. You will get the same effect. So now what we'll do, read. URP is deducted from S company's reporting date net assets. URP will be deducted from S company's reporting date net assets and group inventory. Okay, so that's the difference. That's simple difference. When P2S, if the sale is P2S, then URP will be deducted from consolidated reserve and group inventory. And if it is S2P, sale, then URP will be deducted. Look at here, URP will be deducted from S company's reporting date net assets and group inventory. Okay, I hope you remember these rules. These are very basic things, or even you don't need to remember it, just think it. You can do it with concept as well. Now, one more thing, how to calculate URP. Wait. Oh, there is one basic method of calculating URP, and some students also use their own method. I am telling you one basic method. Whenever in case of inventory, whenever you need to compute, in case of inventory, P2S sale or S2P sale of inventory, and whenever you need to calculate URP, how you do it? First of all, calculate the total profit of the transaction. Number one. And number two step, just simply apply that total profit with the percentage of unsold inventory. The inventory that has not yet been sold by the year end, you will get the URP. Okay, repeat. For URP, First of all, always calculate total profits. First of all, calculate the total profits, okay? And then multiply it with unsold inventory percentage of year end. You will ready-made get URP. That's it. That's the best method. Or you can see this, see in this question. In this question, it is written in the sketch, you can see 30% goods are sold, 30% goods are sold. And this, see this, 70% are still with the company, 70% are still with the S company. So that means 70% is URP. That means 70% is URP. 70% is URP. Okay, right? Now, one more topic, and this topic is only in F7, not in F3. Not in F3. This is only specifically in F7 and SBR and all these papers. Now, P to S sale of non-current asset, P to S sale of non-current asset. Okay, I'll try to do my best. Please keep aligned. Now, for example, see this screen. Parent company sold goods, sold plant. Parent company sold plant to S company with NBV of 1000. The carrying value at the date of sale. The carrying value at the date of sale is 1000, and parent company sold this plant to S company for 1500. Okay, so within a second you will calculate URP. Within a second you will calculate URP. So what's the difference? See, what's the difference between these two? 1500 and 1000. 1500 and 1000. The gain on disposal, or you call it profit on disposal, is 500. Gain on disposal or profit on disposal is 500. Okay, now wait. As this is P2S sale, the first step is very quick. As this is P2S sale, this profit is booked by parent company. As this is P2S sale, that's why this profit is booked by parent company. So it's this URP is in parent company's P&L, so definitely in the parent company's retained earning. So now when it is in the parent company's retained earning, it is automatically gone in consolidated reserve. So first step, you need to remove this URP from consolidated reserve, and group plant and machinery. And group plant, now it's not inventory, now it's plant and machinery. Now it's not inventory, now it's plant and machinery. Okay, so you need to remove it from group plant and machinery. Okay, is my voice clear? Boys and girls, please respond. Is my voice clear? Am I audible? Okay, thank you. Now, so first of all, you need to remove this 500 from consolidated reserve and group plant, as this is P2S sale. Now, one more thing, just think. S company, look at me. S company just bought this plant for 1500. S company just bought this plant for 1500. So S company started depreciating it using this 1500 amount, and the life is 10 years. So obviously in the S company's books, S company has recorded 1500 divided by 10. 1500 divided by 10, the depreciation of 150. S company has booked depreciation of 150 in its individual books, okay? But you just think over it. From the group point of view, this is not a sale. This is inside transaction. This is not the sale. So from the group point of view, this asset must have been recorded at 1000. This asset must have been recorded at 1000. So from the group point of view, it should have been depreciated using the same 1000 amount, and 1000 divided by 10 is 100. So now let's compare. S company has booked the depreciation of 150, and from the group point of view, it should only be 100. So how much extra depreciation? How much extra depreciation? S company has booked 50. Open your ears and eyes. S company has booked 50 extra depreciation. Now, if you know depreciation is an expense, that means S company has booked extra expense of 50. So S company's profits and S company retained earning will go down by 50. Must have been go down by 50. Now we need to reverse it. We need to correct it. So what I will do, I will add 50. I will add 50 in S companies post retain earning. And when I'll add 50 in S companies post retain earning automatically, or in other words, I should adjust S companies closing post net asset packets, sorry, closing net asset packets. I should adjust S companies reporting date net asset packet with this extra depreciation. Okay. So now look at the first transaction. See, P2S. Look at the screen. Look at the screen. Look at the screen, please. If non-current asset is sold from P to S, what's the transit? There are two steps. URP is deducted from CR and group plant. The second step, excess depreciation will be added in S companies. Excess depreciation will be added in S companies reporting date net assets and group plant. Okay. And now, if this is S to P sale, you have to do vice versa. If this is S to P sale, you have to do vice versa. What? If this is S to P sale, then definitely S to P sale, think over it. S to P sale, URP is booked by S company. In S to P sale, URP is booked by S company. So definitely we'll remove URP from S company's books. And when we'll remove URP from S company's books, so we need to adjust, we need to deduct, we need to subtract S company's reporting date net asset packet. See the first step. URP is deducted from S company's reporting date, net asset packet and group plant. This is the first step. And now when this is S to P sale, now when this is S to P sale, that means this time think over it. Extra depreciation is booked by parent company. This time extra depreciation is booked by parent company. So definitely we need to adjust, we need to add CR, we need to add CR and group plant with excess depreciation, Look at here. Now, types of consideration. Simple. When parent company buys S company, that means the running business of S company. So definitely parent company buys from some people, the existing owners of S company. Even this topic you have studied in ratio analysis. Oh, one question somebody asked. CR means consolidated reserve. CR means consolidated reserve or consolidated retained earning. One question, will you provide these notes? Yes, I'll share these slides on the WhatsApp group. Don't worry. I'll share everything. Now, so when parent company acquires or take over S company, so definitely parent company gives some price. Parent company gives some consideration to the owners, to the existing owners of S company, right? So there are different ways. There are different ways in which you can give, to your to the S company's existing owners. The first and the very super hit, that is cash consideration. This is very easy. You can just look at it. Parent company pays cash, so the entry will be debit investment, credit cash, debit investment, credit cash. Sometime parent company issues its own shares to the S company's existing owners. It means in reality, think over it. It's like exchange of shares. It's like exchange of shares. Parent company buying S company shares, and in return, parent company issuing its own shares, right? So what's the entry? As parent company has just bought these shares of another company, and whenever one company buys shares of another company, this is investment. So what we do? Debit investment. Now wait. Now parent company just issued new shares. Whenever any company issues new shares, they credit ordinary share capital with face value, and the remaining difference will go in share premium. Okay. So the entry is debit investment, credit share capital, and credit share premium. Okay. Now the third The third style of consideration is loan note consideration. Sometimes it happens, parent company, when parent company buys shares of S company, when parent company buys shares of S company, in return, parent company issues its own shares. In return, parent company issues the loan notes. Parent company issues its own loan notes, right? So what's the entry? See, parent company has just bought the shares of another company. Parent company has just bought the shares of another company, so debit investment, and in return parent company has issued loan notes. And you studied this in financial instrument or basic on in your basic F3. Whoever company issues loan note, that means liability in their books. Okay, so loan notes is a liability, issuing loan note is a liability. Okay, so that's the third way of consideration. Now, there is one more way of consideration. Normally, it comes in SBR, but it's very easy, so I can explain you in 1 minute, or maybe it may come in your paper. Now, that is fixed asset consideration. Fixed asset consideration. Fixed asset consideration. What is fixed asset consideration? Look at here. Parent company has just bought the shares of S company, and in return, parent company has given a land or plant and machinery as a consideration. Yes, it is possible. So what will be the entry? Now wait, parent company has bought the shares with market value of 5 million. Okay, so we have just bought the shares, so investment will be debited by 5 million, and the carrying value of our land at the date of this transaction is 3 million. So just simply think over it. The carrying value of our non-current asset was 3 million, but in return we got 5 million shares. In return we got 5 million shares. So obviously there is a gain on disposal of 2 million. There is a gain on disposal of 2 million, which is to be booked in P&L. So the entry will be investment debit, land credit. Parent company has given away the land to the S company's owners, and the P&L credit. Now, one technical issue, please don't get confused. Sir, do we book this gain in our consolidated P&L? Yes, we'll book this gain. Why? This is not an intercompany transaction. But parent company has given this land to the S company shareholders. They just think over it. They are human beings. It's not S company. I repeat, parent company has not given. Look at here. Parent company has not given this land to S company. No, parent company has given this land to S company shareholders, existing owners. Okay, so this profit is totally realized from group point of view. Shareholders are external people. If there is a transaction between P and S, P company and S company, and there is a profit, then that profit is unrealized. This is a technical concept. Now, very famous topic, deferred consideration. Deferred consideration, what does it mean? Very simple. You must have studied by now if you are F7 FR student. Listen, deferred consideration means parent company has just bought the shares of S company from the S company shareholders, and parent company in return just gave the promise words that we'll pay you next year, or we'll pay you after 2 years. Okay, so now the basic thing of F7, the basic idea of F7, I hope you remember. Whatever payments are deferred for 1 year or more, whatever payments or obligations which we have to pay within 1 year or more, we need to discount it. Okay, so what is the first step? Compute. This is not complete, this is compute present value, compute present value of future cash flows, and make entry. Wait, first of all, if you are paying, see the screen, if you are paying, you have to pay 1100 after 1 year. So just first of all compute the present value. The present value of that 1100 now is 1000. So what you will do, you will make the entry debit investment and credit deferred consideration, investment debit and credit deferred consideration, because you promise, it's your obligation. See, this is the first entry. Look at here. debit investment and credit deferred consideration. It's your liability. Now when this whole year will be passed, you need to do unwinding of discount. You need to do unwinding of discount. This is unwinding of discount. Okay. And whatever, let me tell you the one super hit dialogue. Whatever rate is used for discounting, whatever rate is used for discounting, the same rate is to be used for unwinding. Okay. And so the difference between 1000 and 1100, as this is only 1 year transaction, so the difference between 1000 and 1100 is 100. So what entry you will make? You will make the entry debit interest expense and credit that liability. And when you credit this liability, so automatically this 1000, see, plus this 100, this will become 1100, and you have to pay 1100 to the other party. So automatically at the year end, your liability will come to 1100. Your liability comes to 1100, right? Now one more thing. You may ask, sir, why have you written CR here? Why have you written CR here with interest expense? Because look at here, let me give you logic. As this liability was the liability of parent company, this deferred consideration was the liability of parent company, because parent company gave the words to S company shareholders. So this is the liability of parent company. So definitely when this liability belongs to parent company, this interest expense belongs to parent company as well. And in 99.9% questions, 99.9% question, examiners does not record this complete transaction of deferred consideration. So you need to do it yourself. So that means this interest expense has not already booked by the examiner. This interest expense has not ready-made booked by the accountant. So now when you will book this interest expense of parent company, so parent company profits will go down. And when parent company profit goes down, parent company's retained earning goes down. And when parent company's retained earning goes down, automatically consolidated reserve will go down. Are you getting? Okay. So these are the two entries. For deferred consideration. And today in the past paper we'll also do this part topic we'll also do in the past paper. Okay. So don't forget. And this investment 1000 will be part of your COI, cost of investment. Okay. Now one more thing, very interesting thing. Listen, with the deferred consideration, I have written unconditional promise to pay cash. Unconditional promise to pay cash. That means no conditions attached. I have parent company has openly told as company's owners, yes, we will pay you the amount at any cost. This is not a conditional payment. This is unconditional payment. Unconditional. Parent company has to pay. Okay. No conditions attached. Now there is one last consideration. Which is called contingent consideration. And now read the word. Conditional promise to pay cash. Now parent company has told S company's owners that we'll give you 2 million cash after 2 years if this company's profits goes up, or if this company EPS touches this, if the market price goes this way. So definitely now the conditional promise. Okay. Now after 2008, open your ears and eyes. After 2008, according to the revised IFRS 3 business combination, contingent consideration must always be recorded at fair value. Don't forget, contingent consideration must always be recorded at fair value at acquisition date. See this, at fair value at acquisition date. Okay. And this fair value, 99.9 in 99.9% cases, this fair value will be ready-made given to you. I repeat, according to revised standard IFRS 3 business combination, contingent consideration must always be recorded at fair value, at its fair value of acquisition date, and this fair value will be given ready-made to you. This fair value will be given ready-made to you. Okay, wait, azan is going on. Okay, we are taking a short, quick namaz break of I think 7 to 8 minutes, and then we'll shortly start resume the session. Okay, right? And then I'll answer your questions. One student has asked a question about the legal cost to acquire. All professional cost to acquire at the time of acquisition goes in P&L. Simply, P&L means CR. Parent company's P&L means CR. Okay, a short break. Okay. Okay, students, please be active. Now we have contingent consideration. What is contingent consideration? I just told you before the mass break that now parent company has done conditional promise. Okay, so how we are going to record it according to revised IFRS 3 business combination, contingent consideration are recorded at fair value. Contingent consideration are recorded at fair value. Okay, and this fair value is normally ready made given to you in the question. So for example, giving you one example, and I think this example came in one past paper as well. Peakend, there is a very famous question Peakend. In that Peakend question, this example is given. So for example, in this question there is a contingent consideration, and the fair value of that contingent consideration at acquisition date is 1000. Fair value of contingent consideration at acquisition date is 1000. Okay, so what entry you make at the acquisition date? You will make entry debit investment. Obviously parent company is buying shares, debit investment, and credit contingent consideration. Debit investment and credit contingent consideration. Okay, and this is your liability. Normally it's your liability. Right now, look at me. Now it is possible that after a year, that means at the end of the reporting date, the conditions may fluctuate. The reality may fluctuate. For example, you promise to pay, but now there is less chances of paying. So automatically the fair value of that liability, may be revised. So now the fair value of that liability is only 700. Fair value of that contingent consideration obligation is only 700. So at the acquisition date it was 1000, now it's 700. So how we are going to account for this change? We'll simply report it in consolidated reserve. Wait, we'll make the entry. Our liability was initially 1000. Now your liability is only 700. So what entry you will make? You will make the entry contingent consideration debit. Debit your liability. You will debit your liability, contingent consideration debit, and P&L income credit. And when you will credit P&L of parent company, and when you will credit P&L of parent company, when you will credit P&L of parent company, obviously profits of parent company will go up, and when profits of parent company goes up, consolidated retained earning automatically goes up, group retained earning automatically goes up. Okay, so these two entries you have to make, right? Okay, you can see. Quick, read it. Don't worry about the slides. I'll provide you. Now let's move to one more topic, and that is fair value adjustment. Now wait, as we all know, look at here. As we all know that the formula for goodwill calculation is cost of investment, assuming the holding is 100%. Assuming the holding is 100%. Please look at me. Assuming the holding is 100%. So let us say the formula of goodwill is cost of investment less fair value. See, less which value? Fair value of net assets of S company. What's the formula of goodwill calculation? Cost of investment less which value? Come on, say it. Fair value of net assets of S company. So this is mandatory, obligatory, that S company's net assets must be at fair value. But this is not always the case. So it, in many questions, or I must say in all questions of SOFP, normally S company's net assets are not at fair value. So you need to do it. And this act or this hard work is called fair value adjustment. Okay. So just remember this number, this equation. C is equal to A minus L. Already it is written. C is equal to A minus L. So how do they give it? For example, you have a land of S company. S company has a land with carrying value. Already carrying value is 4,000, but the fair value is 6,000. That means S company's land is not at fair value. So you need to bring it to fair value. So from 4,000 to 6,000, there is an upward journey. From 4,000 to 6,000, there is an upward journey. So you will increase S company's assets by 2,000. You will increase S company's assets by 2,000. So automatically when assets goes up, the net assets also goes up. Okay. So what you will do, how you will post? C, you will post this in S company's net assets packet at acquisition date, S company's net assets packet at acquisition date. And now as this is a non-depreciating asset, the first case is as now this is a non-depreciating asset. This is a non-depreciating asset. So the value has not changed at the reporting date. So you will adjust the same amount. In reporting date packet. Okay. So how are we going to account the fair value adjustment? Fair value adjustments are simply adjusted in reporting date net assets packet. sorry, acquisition date net asset packet and reporting date net asset packet. And as this is a non-depreciating asset, in the case one, we were studying, we took the example of non-depreciating asset. That's why the same amount in both packets, same amount in both packets. Now the student may ask, sir, what, sir, you have increased the net assets, you have increased the net asset packet. Yes, so do you adjust the assets as well of S company? Yes, obviously. Look, listen my dialogue. Whatever, I will show you the written form as well. Whatever is adjusted in reporting date net asset packet, whatever is adjusted in reporting date net asset packet is also adjusted in on the S company's SOFP as well. Whatever is adjusted in reporting date net assets packet is also adjusted in the closing SOFP as well. Okay. Now, if this is going to be a depreciating asset, for example, the same thing is with the plant. For example, you have a plant of S company. Come on, quick. You have the plant of S company with carrying value of 6,000. You have a plant of S company with carrying value of 6,000 and fair value of 10,000. So from 6 to 10, from 6 to 10, 6 to 10, how much is the upward revaluation? The upward revaluation is 4,000. From 6,000 to 10,000, the upward revaluation is 4,000. Okay. So at the acquisition date, open your eyes. At the acquisition date, look at the screen. You will adjust 4,000. At the acquisition date, you will adjust 4,000. Okay. Now, what are you going to do? What you are going to do in the reporting date? Now, as this is a depreciating asset, so definitely there will be some extra depreciation on this revaluation. Obviously, this revalued amount will also be depreciated. This revalued amount will also be depreciated. So as the life is 10 years, so 4,000 divided by 10 is 400. Now, one very important examination tip. Listen, always, please, boys and girls, please, always don't forget to check the distance. Don't forget to check the distance between acquisition date and reporting date. Don't forget to measure, check the distance between acquisition date and reporting date. Here the distance is clearly 1 year. So only 1 year depreciation you need to adjust. What if this distance is 2 years or 3 years or 4 years? So you need to adjust 2-3 years depreciation in the closing reporting date net asset packet. Okay, because right now we are doing SOFP. And SOFP is always made as at, and SOFP is always made as at. SOFP is always made as at. Okay, right. So as this is only 1 year difference, so 4,000 divided by 10, how much is the depreciation? 400 is the depreciation. So the 4,000 element is depreciated by 400 only. So what else is left? 3,600 is left. 3,600 is left. 3,600 will be adjusted in closing reporting date net asset. This is for depreciating asset, boys and girls. This is for depreciating assets. Okay. Now, again the same dialogue. Repeat. Whatever, which number we adjusted, which number this time we adjusted in reporting date net asset packet, which number we adjusted in reporting date net asset packet. This is 3,600. Which number we adjusted in reporting date net asset packet, which number we adjusted in reporting date net asset packet. The number is 3,600. So this number is also adjusted on the asset side. This number is also adjusted, added on the asset side of S company's SOFP, right? Or simply in simple term, consolidated SOFP, right? Okay. Now one more thing. some students gets confused with the downward fair value adjustment. Listen, look at here, look at here. Some students gets confused with the downward. This was upward. This was upward fair value adjustment. What if the same question with downward? Look at here. Let me change the number. For example, the carrying value is 10,000. Boys and girls, please. The carrying value is 10,000 and the fair value is, wait, the fair value is 6,000. Okay, so from 10 to 6, there is a downward journey, 4,000 downward revaluation. Now how you are going to account for, how are you going to account for this downward fair value adjustment? How are you going to account for this downward fair value adjustment? Same, exactly same, just with negative sign. Exactly same treatment. Let's look at me. Exactly same treatment with negative sign. Look at here. What you will do, you will just write 4,000 negative here and 3,600 negative here. That's it. Same thing, same method, everything same with negative signs. That's it. 4,000 negative at the acquisition and 3,600 negative at the reporting date. That's it. Same treatment, but with negative numbers. And obviously in the reporting date net asset packet, you have used a negative number. In the reporting date net asset packet, you have used a negative number. So that's why on the asset side as well, on the asset side, you have to use a negative number. On the asset side, you have to use a negative number, right? Negative number you have to adjust. Now read this line. In the fair value adjustment topic, sometime it happens that we acquired one subsidiary company. Look at here, we acquired a subsidiary company and there is one unrecognized intangible asset with S company. Why? Maybe S company has some maybe S company has some internally generated brand. S company has some internally generated brand with them. Okay, so according to IS 38, I hope you remember IS 38. According to IS 38, a single company, one company cannot recognize the internally generated brand of the same company, right? For example, Mirchawala Institute has launched a brand internally, so Mirchawala Institute cannot record that brand in his books. Okay, so S company has one unrecognized intangible asset, at the date of acquisition. Okay, internally generated brand. Now parent company has acquired a subsidiary company. So now for parent company, this brand is purchase brand. Now for parent company, this brand is purchase brand. So what parent company will do, parent company will give, look, listen the words, parent company will give the birth to this brand. At the date of acquisition, we will recognize this brand in the consolidated books, and this will be treated as an upward fair value adjustment. This will be treated as an upward fair value. It's the same. C is equal to A minus L. Look at here. See, upward asset and upward capital. Okay, and this will be treated as a normal fair value adjustment. Upward. And if there is a finite life of this brand is given, if finite life of this brand is given, then you need to depreciate in the same way we did. You need to depreciate that asset in the same way we did. Okay, right? The same thing. So this, sometime in fair value adjustment, you see the fair value adjustments of brands, customer list, intangible assets, right? So get ready, you have to face it. Or one more thing. Okay, boys and girls, the formula of goodwill is COI. The formula for calculation of goodwill is COI, cost of investment less fair value of net assets. Look at the screen. The formula for goodwill is COI. I've just enlarged it. The formula of Goodwill is COI less fair value, fair value, fair value, fair value of net assets of S company, fair value of net assets of S company, right? And net asset means this C. Net asset means this C. This C is the net asset. This C is the net assets. So in the 90% questions, 90% question, you see the fair value adjustment of asset. You see the fair value adjustment of this asset only. But sometimes, once in a blue moon, they give you the fair value adjustment of liability as well. They give you the fair value adjustment of liability because yes, net asset has linked with the liability. Assets less liabilities, assets less liabilities. So in your exam, you may find fair value adjustment of liability. And I hope you have studied this topic, fair value adjustment of contingent liability. Okay, so you will be given ready-made fair value of liability and you need to adjust that fair value of liability through base in the same net assets package, in the same net assets packet as we just did. Okay, so get ready for such transactions. Now one more topic, and definitely we will be doing one past paper for income statement as well. Consolidated income statement, consolidated income statement. Now how we do consolidated income statement, how we do consolidated income statement. Look at here, this is P company and this is S company's income statement. This is P company's and this is S company's income statement. Look at here, whatever is the last step of balance sheet. In the balance sheet, you in the last step you do adding together. In the SOFP, last step you do adding together. But in the income statement, just think this is the first step. Whenever you are given two income statement, just do tuck 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 adding together. Simple adding together. Simple adding together. So 1 plus 2 is 3. This is cost of sales. This is GP. This is operating expenses. Okay, and this is your total profit. That's it. So the first step is simple adding together. But now as you just did adding together and then you realized, after doing adding together, you realized that the holding of parent company in subsidiary company is only 70%. The holding of parent company in subsidiary companies income statement is only 70%. Okay, but we did complete adding together, so now we need to compute NCI. And how do we calculate NCI for income statement? This is the super hit formula. What is the formula? S company's profit after tax multiplied by NCI holding percentage. S company's profit after tax multiplied by holding percentage. So S company's profit after tax is just 1500 times 30%. This is 450. Okay. So now we just did 100% adding together. We got, after doing 100% adding together, we got 2200. But we can see and we can think from this 2200, 450 belongs to NCI. So what's the parent company's share? Parent company's owner shares is 2200. Parent company's owner shares is 2200 less 450. So I hope you remember these three lines. What are these three lines? First of all, you write the complete profit. That is 2200. And from this profit, how much profit belongs to NCI? 450 belongs to NCI, and 2200 less 450. 2200 less 450. 1750 belongs to equity owners of P company. 1750 belongs to equity owners of P company. Okay, so simple three steps of income statement. Come on, quick. Adding together, then do NCI, and then these three lines. Adding together, NCI, and then these three lines. This is the basics. Now I'm going to give you a super concept, because sometime in advanced level, some students ask me to do a 5 minute revision of consolidated income statement. I tell them one thing. I just focus on one thing. And now I'm going to do that with you. Can you see the two income statement with you? Can you see the two income statement, parent and subsidiary? Parent and subsidiary, yes. Parent company's income statement is completely added with subsidiaries income statement. See, 1 plus 2, you get this 3000 sales. Parent company's data is totally added in subsidiary company's income with subsidiary company's income statement to get consolidated things. Okay. So now first dialogue, whatever problem is with the parent company's income statement, that problem will be carried forward to the consolidated income statement. For example, if by mistake parent company's sales is understated, so automatically when this problem will be carried forward to the consolidated income statement as well. If parent company's sales is wrong, then automatically consolidated sales is also wrong. If there is a problem with operating expenses of parent company, if there is a problem with operating expenses of parent company, then automatically the same problem will be with the consolidated operating expenses. Okay. So if you do any mistake, or if you forgot to record anything in parent company's income statement, automatically that problem will be shifted to consolidated income statement, and you need to adjust that thing in consolidated income statement. But with subsidiary companies, the story is different. With subsidiary companies income statement, the story is different. See, subsidiary companies data is added. Subsidiary company data is added with P company to get consolidated data. Subsidiary companies income statement data is added with P company to get consolidated data, plus subsidiary companies profit after tax is also used to calculate NCI, because the 30% owners are NCI people, right? So now listen the words. Whenever there is a mistake in S company's book, whenever there is any problem in S company's income statement, that problem will not only affect the consolidated SOCI, but will also affect the NCI working. That's it. That was the real summary. I repeat, if there is a problem with parent company's books, parent company's income statement, that problem will only be adjusted in consolidated SOCI. Okay. But if there is a problem, with subsidiary companies in subsidiary companies books, in subsidiary companies income statement, then that problem will affect not only consolidated SOCI but also NCI working as well. That's the real theme. If you understand this, you understood the whole topic. The whole topic is just moving around these two lines. Now let me share you some data. As we are on the revision days, so we can't do like things like normal class. Okay. Now P2S sale of inventory. This topic I teach in F3 as well, because I teach F3 as well, F3 financial accounting. So now whenever there is a P2S sale, that means there's within the group sale. So this sale is recorded in the sales of one company and cost of sales of other company, sales of parent and cost of sales for subsidiary. So as this is within the group transaction, we need to eliminate. So what's the first step? C. P company sold goods to S company for 500. There is an intercompany sales of 500. There is an intercompany sales of 500. Okay. So now what we do? First step, consolidated sales and cost of sales will be reduced by the amount of transaction. Whatever transaction is done, we'll remove it from sales and cost of sales. Okay. from sales and cost of sales. So right now in this question, that number is 500. That number is 500. So 500 we'll remove from consolidated sales and consolidated cost of sales. Okay. Now the next step. What if there is some URP in this case? What if there is some URP in this story? So now, as look at me, as the sale is P to S, that URP is booked by parent company. As the sale is P to S, that URP is booked by parent company. So this URP, look at my video. This URP is present in this white, is this in this parent company's P&L. Assume this white pen is parent company's P&L. Assume this white pen is parent company's P&L. So when this URP is in parent company's P&L, so look at the screen. And when we add these two, when we do adding together, this URP will go in consolidated P&L as well. So you need to remove that URP from consolidated P&L. And how you will remove it? By C, URP will be added in consolidated cost of sales. And when you increase the consolidated cost of sales, automatically the consolidated profits will go down. Okay. So there are just two steps in P2S sale. Of inventory and income statement. Check it out, please. And believe me, again, this concept is linked to the thing which I told you, the concept which I gave you. Now, S2P sale. With S2P sale, everything is same. First of all, within the group transaction, sales and cost of sale will be removed from consolidation. Number two, if there is some URP, now just think, this time it's S2P sale. So URP in S company's book. As this time it's S2P sale, that's why URP in S company's books. So you need to remove. When URP in S company's book, it will automatically carry it forward. It will automatically go in the group book. See, as URP in S company's books. So after adding together, that URP will be shifted to group books. So first of all, you need to adjust group books. See, URP will be added in consolidated, means group cost of sales. And the third step, hope you remember the original concept. As this time the sale is S2P, that means URP in S company's books. So it must affect NCI as well. So you need to remove. See, URP will be deducted or removed. URP will be deducted from S company's profit after tax in the calculation of NCI. Okay. So these are the steps for P2S and S2P sale. P2S and S2P sale of inventory. Okay. P2S and S2P sale of inventory. Now, P2S and S2P sale of fixed asset. I have seen many students in my life, they do mistake in here because of a very basic concept, because of the problem of very basic concept of related to basic accounting. First of all, when you sell basic accounting, very basic, when you sell inventory to somebody, you book sales, that's your income. But when you sell fixed asset to somebody, you never record it in sales. That is your capital receipts. That's not going to be recorded in the sales portion. Okay, be careful, don't forget this, a very basic thing. So now if P company, this example I already gave you in the balance sheet thing, P company with with a non-current asset of NBV of 1000, P company with non-current asset of NBV of 1000 sold to S company, for 1500. Okay, but still this will not going to come in sales portion. Sales, this is not your sales revenue, my dear. This is non-current asset. This is not inventory. Okay, so no more sales and cost of sales cutting. The same step we did in with inventory here, that step is no more. Now what are the steps? Use your brain, and you will understand. Now first of all, P2S. As the sale is P2S, that means P company sold non-current asset with NBV of 1000 to S company for 1500. That means P company booked URP of 500. P company booked URP of 500. So the URP is in parent company's P&L. URP is in parent company's P&L. So automatically this URP will go in the consolidated P&L. So first of all, you need to adjust consolidated figures. See, URP will be added in consolidated cost of sales. So automatically when you increase the cost of sales, your gross profit will go down. When you increase the cost of sales, your gross profit will go down and your URP will be removed. So this first step is done. Now the second and third step. Hope your brain is active. As P company sold non-current asset of 1000 to S company for 1500, sold expensive. So S company bought it for 1500, and in the individual books of S company must have recorded the depreciation according to 1500 number. Right? So that means S companies, that means, my dear students, S company has booked extra depreciation. And you have studied, you all boys and girls, you have studied final accounts. Depreciation is normally recorded in cost of sales. Nowadays, in recent new questions, depreciation is adjusted in cost of sales. Okay, so S company has booked extra depreciation. Okay, so you need to remove that extra depreciation, and you will deduct it from S company's cost of sales. See, excess depreciation will be deducted because S company has overbooked the depreciation, consolidated cost of sales. And the third thing, as this time the extra depreciation is in the S company's P&L, as this time the extra depreciation is in S company's P&L, so definitely you need to repair the NCI. excess depreciation will be added in S company's profit after tax in the calculation of NCI. Okay, so these are the steps for P2S sale of fixed asset. Okay, now just simply reverse it for S to P. For S to P you read it. For S to P, reverse the thing and think over it. Simple. It's not difficult at all. In S to P, obviously URP is booked by S company, so URP will be adjusted in consolidated cost of sale as well as in NCI, as well as for NCI as well. Have a look, please. Now, How to treat excess depreciation? How to treat excess depreciation of fair value adjustment? First thing, first of all, we are doing income statement. We are doing income statement, not balance sheet. So if you do fair value adjustment, you change the value of asset, it won't hit your income statement. It won't hit your income statement. But yes, if you are doing, look at here, if you are doing fair value adjustment of a depreciating asset, if you are doing fair value adjustment of depreciating asset, yes, so then extra excess depreciation must be adjusted in consolidated P&L. That's a P&L thing. Depreciation is a P&L thing. Now, first of all, don't forget, you have studied final accounts, you have studied, even I'll make you revise some of the questions of final accounts, don't worry. So you know, in final accounts, normally depreciation is booked in cost of sales. So first of all, make your mind that depreciation is a cost of sales item. Depreciation is a cost of sales items. Okay, make your mind. So now see, there is an upward fair value adjustment of S company's plant. S company's plant was already recorded. S company's plant was already recorded at 10,000. Look at here, but the fair value of that plant is 15,000. So from group point of view, from group point of view, we have revalued this plant from 10 to 15. But S company's accountant doesn't know this thing. S company accountant has no knowledge of this thing. And in the S company's individual books, this asset is still at 10,000. So definitely S company's accountant has booked depreciation according to 10,000. But from the group point of view, it should have been booked. The depreciation should have been booked using the 15,000 value. So that means in case of upward fair value adjustment, S company has underbooked the depreciation. S company has booked the less depreciation. So now S company's P&L is wrong. There is a defect in S company's income statement. So now what you will do, you will increase S company's depreciation. You will book extra depreciation, and extra depreciation definitely is booked in cost of sales. Depreciation is booked in cost of sales. So the first step is excess depreciation will be added in consolidated cost of sales. Excess depreciation will be added in consolidated cost of sales. Okay, and now use your brain. I'm sorry, use your this brain. Now as there is a defect in S company's income statement, so definitely NCI will also be affected. NCI will also be affected. See, okay. And now you guys are not in KG or nursery. You are matured guys. This whatever is written here is for upward fair value adjustment. Just do upside down for downward fair value adjustment. Just apply the reverse rules for downward fair value adjustment depreciation. Okay, have a look. Now for impairment. Now impairment of goodwill. Don't forget, goodwill is never recorded in individual books of S company. For S company, the goodwill is internally generated. But yes, from the group point of view, this is a purchase goodwill. That means goodwill is never ever recorded ready made in the S company's books. Okay, so when goodwill is not recorded in the S company's book, that means impairment of goodwill has not yet been adjusted in the consolidated books. You have to adjust by your own. Now what's the concept? Very good concept, listen. And this concept is again linked with that point which I told you this in the starting of income statement. Look at here. As in full goodwill method, goodwill is considered to be a complete asset of S company. in full goodwill method, goodwill is considered to be a complete asset, full asset of S company. So when goodwill goes down, that means this is the loss of S company. When goodwill value goes down, this is the loss of S company. So that means we should adjust S company's individual income statement, but we have not done this yet. So that means now just assume that the defect is in S company's individual books. When the defect is in S company's individual books, so automatically this defect is carried forward to the consolidated books. So the first step, impairment of goodwill will be added in consolidated operating expenses. Impairment of goodwill is added in consolidated operating expenses. And number two, as this is the full goodwill method, and I just told you that goodwill belongs to S company. In full goodwill method, goodwill belongs to S company. So, and S company has not already recorded this expense. So that's why it must be adjusted in NCI as well. See this. This is the impairment of goodwill. This is the treatment of impairment of goodwill. This is the treatment of impairment of goodwill. But now, what if you are doing with proportionate method? Think over it. If you are doing the same impairment of goodwill adjustment with proportionate method, in proportionate method, you remember I taught you in the beginning, in proportionate method, goodwill is only 80% recorded. For example, parent company just holds 80% shares of S company. So the goodwill in the consolidated books is only 80%. That means in proportionate method, listen to my words, in proportionate method, goodwill is considered to be a separate asset of P company, pure P company's asset. And when P company's assets goes down, this is the loss of P company. So this time, no more adjustment in NCA, only look at here, only see this. This is proportionate method. In proportionate method, only consolidated operating expenses are adjusted. No more NCI adjustment. Okay, don't forget, these are basic things. Now, very simple thing. I just taught you the types of consideration, that deferred consideration. Hope you remember, there is an interest expense arises in interest expense, or unwinding of discount arises in deferred consideration, and that unwinding of discount belongs to parent company, because P company promised to S company shareholders for the payment. P company promised S company shareholders for the payment. So this deferred consideration is the loan of parent company. Okay, as this deferred consideration is the loan of parent company, that's why the interest expense of deferred consideration also belongs solely to parent company. And this interest expense has not already been adjusted. This interest expense or unwinding of discount has not already been adjusted in consolidated P&L. So you will only increase the consolidated finance cost. No more NCI. Don't forget the concept. This deferred consideration interest belongs to parent company, not subsidiary company. So what you will do, see this, you will do unwinding of discount. Look at here, unwinding of discount is will be added in consolidated finance cost. In the income statement, unwinding of discount will be added in consolidated finance cost. Okay, no more NCI, as this loan belongs to P company, so that's why only consolidated P&L will be adjusted. No more NCI. One more thing, you know, we just cancel out intercompany things. Sometime it happens that P company, I will teach this question today as well in the past paper. Sometime parent company gives loan to S company. Okay, so in that case there is an interest income in the P company's P&L and the corresponding interest expense in S company's P&L. So you need to cut that intercompany's interest expense and interest income. Okay, that's must. If you forgot to do this, so this interest income will come here and interest expense will come here. Obviously the net effect is zero. But you will be penalized for this presentation error. This is presentation error. It's not allowed to book the same loan interest income and expense in the same books. It's impossible, right? So you must cut all these intercompany things. And what are those intercompany things? Come on, have a quick review. Number one, intercompany loans. If parent company has given loan to S company, so interest income in P company's books and interest expense in S company's books, we'll simply cancel it out. Okay. Number two, if parent company has given building on rent to S company, so rental income in parent company's books and rental expense in S company's books, again cancel out. And the third example for this are dividends. Sometimes what happens, look at here, S companies gives dividends to P company, obviously, because parent company is the biggest shareholder of S company. Parent company is the biggest shareholder of S company. Parent company is the biggest shareholder of S company. So in that case in that case we need to cancel out the dividends as well. Okay, dividends from S company will be canceling out. Okay, now very important area, it may come for 2, 3 or 5 marks. Now there is one left. Normally I normally say this to my students, that this consolidation topics is about the level of investments. So the biggest and the highest level is control. When one company acquires more than 50% shares of another company, it gets control. And with control, the accounting is consolidation, adding together from top to bottom. We do adding together. There is one lesser level. The second level of investment is significant influence. Sometimes what happens when we buy more than 20% and less than 50, 20 to 50, this is the criteria. More than 20% and less than 50% shares of some company, then we get significant influence of that company. What is the definition of significant influence? Power to participate in financing and operating policy of an entity. Now, how this significant influence is verified? Wait, you have more than 20% shares. That means out of 10 directors, two or three directors of yours will sit in the board of associate company. That means two directors or three directors are sitting from your side. That means you have a voice, you have a say in the board of that company. So you can exert significant influence. Right? So now, with significant influence, no more adding together, please. Strictly no more adding together. Only what we do one line adjustment, equity accounting. This is very famous accounting. One line adjustment, equity accounting. Now, what we do in the balance sheet, we'll do one line adjustment on the asset side. And that one line adjustment is, see this, carrying value of investment in associate. See this line, carrying value of investment in associate. Now, how to calculate this carrying value of investment in associate. Please, boys and girls, be active. You have studied something related to this in your F3 and F7 both papers. Please, first of all, in the SOFP you will write COI. COI means cost of investment. That means the original amount you paid, to buy those shares. For example, you bought 30% shares. So first of all, you write COI. Then, and this is the entry. See, I've solved with double entry as well. This is the double entry. This is the first entry. So you bought the shares, you made the entry debit investment, credit cash. Now, the second step, what you will adjust, the post profits. You will adjust the post profits of associate company. You will adjust the post profits of associate company, multiply by your share, okay. So let us say the post profits are 20,000, multiplied by 30% is 6,000. Now, before I tell you the entry, this is the entry, huh? Listen, let me use some historical words. Equity accounting is basically equity. What is equity accounting? In equity accounting, the other company's profits becomes your income. The other company's profits becomes your income multiplied by your share. Your share you can book as an income. Why? Because you are investor, you are the owner. You are the 30%. Parent company is the 30% owner of associate company. Parent company is the 30% owner of the associate company. So that means the 30% profits, of associate company belongs to parent company. So parent company will simply book the 30% share in its P&L. So what will be the entry? See, this is the entry. Let me make it with the numbers. I'm going with the numbers. So the entry will be debit 6,000 and credit P&L or CR. If it is a P&L question, then if it is a SOCI question, then P&L. If this is SOFP question, then adjust it in CR. Now, third thing, few things reduces the investment. And what are those? Number one is impairment. What happens sometimes? That because of losses, the value of this associate company goes down. So when the value of associate company goes down, automatically the value of our investment will also go down. So we'll reduce this investment, and what we'll make the entry? Debit CR and credit investment in associate. Now, the next thing, dividends from associate. What happens? See, this is P company, this is A company, and our holding is 30%. Now, this is a technical thing, but you have to use your brain, no option. What happens? Sometimes A company gives dividends. For example, A company has given dividend of 1,000 this time. So obviously, parent company is the 30% owner. Of A company. And A company has given total dividends of 1,000. Please look at me. A company has given total dividend of 1,000. So out of this 1,000, 30% will go. Out of this 1,000, 30% will go to 30% means 300 will go to parent company. Okay. So now the question is, will parent company record it as a separate investment income? Should parent company record this 300 as a separate investment income? The answer is no. Why? Because parent company has already recorded the complete profit. See, parent company has already recorded the complete profit after tax. Tax share in their own income. And you know, dividends are distributed from profit after tax. Dividends are distributed from profit after tax. So that means this dividend income is already included here. See, This dividend income is already included in the parent company's P&L. Already, this has already been included in parent company's P&L. So if you book this dividend income from a company as an income in the consolidated books, you will do double. You will record income two times. You will record income twice. That's why now you just have to make the entry debit bank and credit investment. You have to reduce the investment because you have already included it in this 6,000, right? And one more thing, if there is a URP from P to A, you need to adjust that thing as well. And finally, you get carrying value of investment in associate. And yes, this carrying value of investment in associate is recorded on the non-current as a non-current asset, in section in consolidated books. Don't forget non-current asset section in consolidated books. And one more important news, this whole equity accounting is for consolidated books, not individual books of B company. This whole accounting which I taught you, see this whole accounting which we are discussing right now is this equity accounting is for consolidated books, not individual books, is for consolidated books, not individual books of P company. Don't forget this. Okay. Check it out. Please check it out. So now with associate in the balance sheet, look at me in the balance sheet, only one line adjustment. In the asset side, you just have to write carrying value of investment and associate. And these are the maximum thing which goes in carrying value of investment and associate, maximum things, all things I've told you. Okay. And in the consolidated balance sheet, we have to adjust CR as well. See this, I made the entry CR here. So only two things, whenever you get the question of associate and you have to make consolidated balance sheet, look at here, whenever you get the question of associate and you have to prepare consolidated balance sheet, just two things keep in mind, two things you have to do. Number one, you have to calculate carrying value of investment and associate for asset side. You have to calculate carrying value of investment in associate for asset side. Number one. Number two, you have to adjust CR where it is relevant. You have to adjust CR where it is relevant. Okay. Now, just a quick recap, because we have to do questions as well. Quick, because this is basically question based revision session, but I have already given 2 hours for these things. Listen, sometimes it happens P to A and A to P. Parent company sold goods to A company and A company sold goods to P company. Okay. So what you have to do in that case, first you look at the step. First you have to calculate URP as normal, and then don't forget to multiply it with the holding percentage. This is the key. This is very key step. Hope you remember. With subsidiary, when you are dealing with subsidiary, you adjust complete URP. When you deal with your subsidiary, you adjust complete URP. That's final. But when you deal with associate, my dear boys and girls, look at here. When you deal with associate, what amount you adjust? You first calculate URP and then you multiply it with your holding percentage of associate. And now this number you have to adjust. Don't forget. Okay. So with P2A sale, what is the entry of P2A sale? The entry of P2A sale is consolidated reserve. You have to reduce CR and you have to reduce investment and associate, which we just discussed. And when it is A to P sale, when this is A to P, then we do CR and group inventory, because now the URP is included in parent company's inventory. URP is included in parent company's inventory, and we can adjust parent company's inventory easily because we are parent company. Okay. So these are the entries, but the key is, this is the key. This is the main error which students do. What's the error? What's the error? When you deal with subsidiary, adjust complete URP. Simple. But when you deal with associate, 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 then only one thing. URP multiply by your holding percentage and then post the entry, then adjust it. Okay. Now, simplified version of income statement. In associate question, normally in associate income statement questions, normally you will be given three columns. You will be given three columns: parent company, subsidiary company, and associate company. Parent company, subsidiary company, and associate company. Very easy. Between these two, between parent and subsidiary, you do adding together. Between parent and subsidiary, you do adding together. That's it. You know that. But with associate, never do adding together. Only one line adjustment again. With associate, never ever do adding together. Only one line adjustment. That's it. Okay. So what's that one line adjustment? The name of that one line adjustment is associate share of profit. Associate share of profit. And how do we calculate associate share of profit? Very easy. Simple. A company's profit after tax, multiply by your holding. A company's profit after tax multiply by your holding. That's it. Okay. One more thing. Be active. Sometime it happens that associate is only for half of the year. You have acquired associate in the mid of the year, and you have to calculate, you have to adjust associate share in income statement. So as you know, income statement is always for the year. Income statement is always for the year. So don't forget to apportion the profits of associate company for associate share of profit calculation. Okay. In that case, you need to apportion the profits. Please be careful. So first thing is this. Now, second thing, if there is some impairment of associate, that means that's definitely parent company's loss. So simply adjust this loss here. Simply adjust that impairment of investment in associate loss here. So automatically your associate share of profit will go down. And when your associate share of profit will go down, automatically this will affect consolidated income statement. Then one more thing, if there is P to A or A to P, see the same treatment now according to the revised standard, same treatment for A to P and P to A in income statement. In income statement now, according to revised rules, A to P and P to A, same treatment. Just deduct the URP adjustment here, and this final is one line adjustment. Let me write, add this in consolidated SOCI after gross profit. After, that's it. See this, let me make the walls. This is a one window. Wait, sorry. This associate share of profit is a one window thing. Just compute it and adjust it in as a one line in consolidated income statement. That's it. And one more thing I told you, if it is P to A or A to P, in income statement according to new latest rules, it's simply adjusted. It's simply adjusted in associate share of profit. But don't forget, don't adjust the complete URP. Don't adjust the complete URP. Only URP multiply by your holding percentage. Okay, I already told you. See this. URP for associate, URP multiply by your holding percentage, not just complete URP. Yes, with the subsidiary thing, we can adjust complete URP. Okay, but with the associate thing, never. First apply holding percentage on URP and then do it. Look at the screen. Look at the screen, please. Now, this is a little quick theory. IFRS 10 and IFRS 3. The name of IFRS 10 is Consolidated Financial Statement, whereas IFRS 3 is Business Combination. What's the role of IFRS 10 and IFRS 3? Short review. IFRS 10, IFRS 10 tells you that whether you have control in this subsidiary or not. IFRS 10 tells you whether you have control in that subsidiary or not. If you have control, if IFRS 10 gives you green signal, yes, you have control, then go ahead with the consolidation. Go ahead with the consolidation, whatever we discussed. And how you will do practical consolidation, how you will do that practical consolidation, that thing will be taught by IFRS 3. That is IFRS 3. IFRS 3 tells you how to do practical consolidation, how to do fair value adjustment, how to do P to S, S to P, and everything, whatever fair value adjustment, everything we have discussed. Okay. So the difference is IFRS 10, IFRS 10 tells you whether you have control in that company or not. Okay. And once you got the message, yes, we have control now, whole practical consolidation is discussed in IFRS 3 business combination. Now, this is the definition of control. Just for your convenience, just have a look. When investor has control in investee, when you have power over investee, you have rights to or exposure of variable returns, and you have the current ability to exercise power through your involvement. And I hope you remember this thing. Control normally comes with 50% plus holding. Control normally comes with 50% plus holding. This is the normal rule. But in the theory sections, all teachers teaches this thing that sometimes control comes with less than 50% holding. Exceptions. Do revise it as well. Do revise these exceptions. How? Sometimes control comes with less than 50% shares through contractual arrangements. Sometimes you get the power to appoint. Sometimes parent company get the power to appoint majority of directors of S company without 50% holding. Yes, if that is the case, then you don't need the holding percentage. Control is there. So the real thing is not holding percentage, real thing is control. Yeah, real thing is not holding percentage, real thing is control. Yes, I'll give you a break shortly. One student is asking about the break. Yes, I'll give you, I know, don't worry, I'll give you a break, and then after the break we'll start directly to the questions. We'll go to the question bank. Now, there is a case which sometime comes in exam, and it is present in pyramid or some questions, and this is a goods in transit case. See, for example, in the adjustment it is given in the, this is the exam kit question as well. In the question it is given, parent company's record says that parent company has done sales to S company. Parent company has done total sales to S company of 15,000. Parent company has sold goods to S company for 15,000. But S company record says that we have only bought goods of 13,500. S company record says that we have only bought goods of 13,500. That means there is some goods which are in transit. What does it mean? Just assume it that on the last day of accounting period, parent company loaded a truck with goods, and the truck is going on the way. Okay, so that truck is in transit, that truck is in air. Okay, so now when these goods are in transit, you know this thing, whatever is in transit, you have to take it to the destination, you have to take it to the other destination. So now when these goods will arrive to S company, just use your brain. when these goods which are in transit will reach S company, we need to make this entry. See this, we make entry goods in transit, or some people write it GIT, goods in transit debit 1500, and payable S companies payable credits 1500. First entry what we have to make, goods in transit debit 1500 and payable credit 1500. Goods in transit debit 1500 and payable credit 1500. Okay, so now wait, now first of all adjust this entry. How you will adjust this entry? You will go in the S company's balance sheet. Look at here, you will go in the S company's balance sheet and you will increase inventory by 1500. You will increase S company's inventory by 1500 and S company's payable by 1500. First of all adjust this entry. You will go in the S company's balance sheet. You will increase S company's, look at here, S company's inventory by 1500 and S company's payable by 1500. Now this is first thing. Now use your brain. Second thing, just think, just read this line. Read this line. As these goods have not reached S company by the year end, as these goods have not reached S company by the year end, so definitely these goods are not yet been sold to third party by the year end. First S company will receive, then S company will transfer to somebody else. Think over it. So as these goods have not reached S company by the year end, so how is it possible that these goods are sold? So definitely these goods contain URP. Whatever profit is included in these goods are total URP. So you need to calculate URP and you need to adjust. And now as this is P2S sale, you know the rules of URP for P2S sale. Let me make the entry here. What's the entry? The entry, let us say URP is 500. Assuming URP is 500, so we'll make the entry CR debit and group inventory credit. Okay, that's how we work. With goods in transit things. That's how we work when with goods in transit things. First of all, adjust this entry. This is the first entry which you have to adjust, and this is the second. And you know, the entries are not mandatory. If you don't want to make entry for URP, no need. If you don't want to make entry for URP, no need at all, right? Ignore it, no need. Just simply directly adjust CR and group inventory. Okay, now let's take a short break, say 5 minutes break. Just refresh yourself, and then we'll start the question thing. Okay, right? 5 minutes break. Let's start the class. We are going to do the first question. That relates to income statement. I've originally planned to solve 2 questions with you. Let's see now. And this is the latest past paper. If you go to the net, you will find this question. This is the latest past paper. Okay, I can share the question with you. Wait, on the group. Yes, I've sent you. If you want to see the question on your screen, I've already sent you. Okay. Now, if you want to take the picture from here, you can take. No issue. But the question is visible here. Now, time is important. Please, let's start. This scenario relates to two requirements. There are two requirements of this scenario. We are going to do the first one. Plank company, come on, be very active, please. This should be the two-way traffic, not just energy from my side but from your side as well. Okay, it should be two-way traffic, then you will understand. Please don't lose your hope. You have to clear this paper in this attempt. Okay, and this is possible. You have already enjoyed a lot in corona. You have taken big leaves. Please. Now, Plank has owned 35%. 35% means this is associate. This is associate. This 35% is associate. This 35% is associate. Okay. Since 1st June X7, biggest dodge. Biggest. This is called dodge. This is called dodge. See, what's your year end? Just see. Our year end is 31st December X8. 8. Not 7. Not 7. Our year end is 31st December X8. And we bought this company in X7. So that means 1.5 years, more than 1.5 year. So that means for the December 2008 year, for the December 2000 X8 year, this company is yours for the whole year. Not getting. This is the dodge. After looking at June date, what students do, they start apportioning the profit of associate for associate share of profit. Don't do it. In income statement, you have to prepare SOCI for always, for the year, for the whole year. And in December X8, your year is December X8. For the year ended December X8, this associate is with you for the whole year. So complete profit. See, this is the profit after tax. This is the profit after tax of a company for in order to compute associate share of profit. I'll use this complete profit after tax. Okay, don't worry. Now, and it acquired 85% of the strip company. Obviously, this is subsidiary. On, yes, this date, on 1st April X8, please give me time and energy. Look at here. I need your attention now. Yes, subsidiary is acquired on the midway of December of the year end, for the year ended December X8. That means from 1st April to 31st December X8. From 1st April to 31st December X8, subsidiary is only with us. Subsidiary is only with us for only 9 months. So for for this subsidiary company, we need to do 9/12. For this subsidiary company, we need to do 9/12. Don't forget, my dear boys and girls. Okay, I need one thing. First of all, are you getting the last 2 hours? Did you understand anything? Please write on the chat, please. At least this is my right. Write on the chat. I need to listen. I need to see. Did you understand things? Please, all of you, just one text. This is my tip. One text is my tip. Okay. Thank you. Thanks. Please, now concentrate again. So with parent company is yours for the whole year. In all questions, parent company's data will come all complete. But subsidy for subsidiary company, you have to do 9/12 because this is income statement question and you just check the date. Okay. And for associate, complete year. Okay. Wait, Azan. Just 1 minute break. Azan. Now, okay. So parent companies data will come complete, and as companies 9/12, and associate companies definitely full year, because we bought the shares of associate company last year. Now, just one request: I'll also solve everything with you. Don't worry, but keep a calculator with you so that you can do things. You can verify things immediately. Okay. Now, a fair value, when parent company acquires subsidiary company, parent company accountant does fair value adjustment. Okay, if something is not at fair value, a fair value exercise conducted on 1st April exceed concluded that the carrying amount of strip, means as company's net assets, were equal to their fair values, with the exception of an item of machinery which had a fair value of 8 million in excess of its carrying amount, right? So a blind student can say, sir, this is upward fair value adjustment, this is upward fair value adjustment. Okay, so we know fair value adjustment won't come in the income statement, but yes, the depreciation thing will affect consolidated income statement. We just discussed. At 1st April, like I said, the machinery had a remaining life of 3 years. Depreciation is charged to cost of sales. Easy peasy, very easy. Don't worry. How you will calculate the extra depreciation? 8,000. 8,000 is the revaluation amount. Divided by, first of all, calculate the per year depreciation. Divide by 3 years. If you divide it by 3 years, see, just think, in the denominator it's years, in the denominator it's years, so your answer will be in per year, your answer will come in per annum, and then finally multiply it with 9 upon 12, because in this question there is a gap of only 9 months. There is a gap of only 9 months from 1st April to 31st December. So only 9 months depreciation issue which you have to adjust. So this 8,000, can you write in the chat box? Somebody can. 8,000 divided by 3 times 9 upon 12. 8,000 divided by 3 times 9 upon 12 is the excess depreciation. 2,000. Yes, the number is 2,000. This 2,000, this 2,000. Okay, thank you. This 2,000 will be adjusted in consolidated cost of sales. How? As this is upward fair value adjustment, so we will add this 2,000 in consolidated cost of sales. We will add this 2,000 in consolidated cost of sales, and also this 2,000 will be deducted from S company's profit after tax in the calculation of NCI. This 2,000 will be deducted from S company's profit after tax in the calculation of NCI. Why? I told you, because this is the S company issue. This is the S company issue, and S company issues always hit at two places. S companies issues always hit the consolidated income statement as well as NCI. See, this is the practical implication. Okay. Now, second. Now you have P to S and P to A sale. P to S and P to A sale. Again, this is routine marks. This is latest past paper. Go and check on the net. I think it's 2020 or latest 2019 paper. Very latest paper. Since acquisition, Plank company has sold goods to strip company totaling 39 million. Okay. Apply the first step. And this is the goods. Goods means inventory. P to S sale of inventory. P to S sale of inventory. The first step, the sale is 39 million. This 39 million means 39,000 will be deducted from sales and cost of sales both. This 39,000 will be deducted from consolidated sales and consolidated cost of sales. Don't forget, be active, don't sleep, please. Now let's see, is there any URP? Yes. Strip company had one quarter, 1/4. 1/4 means 1/4 of these goods in inventory at 31st December X8. Yes. Now stop here. Stop here. How do we calculate URP? How do we calculate URP? How do we calculate URP? Very simple. First calculate the total profit. First calculate the total profit of this transaction and then multiply it by 1/4, the unsold percentage. The unsold percentage of inventory, you will get URP in seconds. Now, for that, you need to see the markup and margin. Markup and margin. Wait. All of these goods had a markup. Now, please don't expect that I'll teach you markup and margin here. You are old guys. You are with beard. Please, you are old guys. So all these goods had a markup on cost of 30%. And this is, see, this 39 million is the selling price. This 39 million is the selling price. So just for your understanding, in markup, cost is always 100%. And when you add 30% in the cost, so the selling price is equal to 130. Selling price is equal to 130. Okay. So now how will you calculate the total profit? Just 39 million, right? Like this. See, 39,000 divided by 130 times 30. 39,000 divided by 130 times 30. 39,000 divided by 130 times 30. This is your total profit is, I think, 9,000. Somebody told me total profit is 9,000. Okay. And now how much goods are unsold? 1/4. So 9,000 times 1/4, I think 2250 is your URP. 2250 is your URP. 9,000 times 1/4, 2250 is your URP. Okay. So in short, as this is a P2S sale, so only two steps in income statement. Don't worry, relax. As this is P2S sale, only two steps in the income statement. The first step is 39,000 should be deducted from consolidated sales and consolidated cost of sales. And the second step, this URP of 2250 will be added in consolidated cost of sales. That's it. Done. Wait. Now, next, there is one P2A sale which is easy. During the year, Plank Company also sold goods to Arch Company, definitely the associate, for 26 million. This is the sales amount of which all of which our company held in the inventory. So 100% goods are with the associate company. So the complete total profit is URP. Now in this case, the complete total profit is URP. Wait. So wait. Well, how do we calculate profit now? You know the rules of markup. 26,000 divided by 130 into 30. This is your complete URP. 26,000 divided by 130 into 30. Do it. 2,100. This is your URP. Now a dodge. This Arch company is your associate. I told you today, I focused you. Even I changed the pitch of my voice when I was teaching you this topic. Listen. In the case of associate, you need to multiply URP with your holding percentage. Before adjusting associate URP, always multiply. I think holding is 30%. Wait, let me check. Sorry. Holding is 35%. Holding is 35. So 2,100 times 35% is how much? 2,100 times 35% is 1,800. Okay. So this 1,800 we'll adjust. And how do we adjust? One step. In income statement, either it is P to A or A to P. In income statement, either it is P to A or A to P. Simply deduct this amount from associate share of profit. in income statement is P to A or A to P, P to A or A to P. Simply deduct this amount of 1800 from associate share of profit. Please listen the question very carefully. Why you are saying this? Total URP, somebody saying total URP 6,000. Somebody 26,000. Yes, wait. 26,000 divided by 130 into 30. How much is this? Oh, this is 6,000. Sorry, somebody wrote wrong amount and I copied it. I got the point now. Wait. Yes. This is 6,000 times 35%. 2,100 is your amount of adjustment. I got it. Thank you, boys. 2,100 is the amount of adjustment which you need to deduct from associate share of profit, which you need to deduct from associate share of profit, please. Okay, next. The investment income of Plank. The investment income of Plank for the year ended 31st December X8. Now, you have the question. You can check it in your WhatsApp as well, and I'll show you the question as well. There is some investment income with parent company books in the P company books. Includes dividends. See, include dividends from strip and arc. It also includes 5 million interest receivable on a loan made to strip company on 1st April X8. Now, this is very technical transaction. Wait. Obviously, we'll remove the dividends. Don't worry. We'll remove the intercompany dividends definitely. But first, let's fix this interest income. And just think. Parent company acquired S company on 1st April, not 1st January. Parent company acquired a subsidiary company on 1st April, not 1st January. So this is the takeover period. The post period is only 9 months. The post period after takeover is 9 months. Okay, and parent company has given loan to S company on the same date. See, 1st April. So that means this 5 million interest belongs to only 9 months, last 9 months, not getting. As parent company has given loan to S company on 1st April, so S company has used the loan for last 9 months. S company has used the loan for last 9 months, and they are openly saying that this 5 million in interest income relates to that loan which made on 1st April. So this is ready-made 5 million income of last 9 months. So we don't need to apportion it. Don't apportion this interest income and expense. No need to apportion this 5 million. This is ready-made last 9 months number. So this 5 million you have to cancel out. Yes, this 5 million you have to remove. From parent company's interest income and S company's interest expense. From parent company's investment income and S company's interest expense. Let me do it for you. See, this 5,000 you need to subtract from here and from here. Okay. This is totally intercompany thing. This is a total intercompany thing. Yes. And out of this 14,000, see this finance cost. Out of this 14,000, 5,000 is intercompany, and that 5,000 belongs to last 9 months. So purely simply remove it, and then the remaining 7,000 will be apportioned. 7,000 you have to do apportionment of 9 upon 12 before doing adding together in the income statement. Before doing adding together in the income statement, you have to do 14,000 minus 5,000 into 9 upon 12. Yes, one question. Sir, how can you say that the remaining 7,000, the remaining, see, sorry, 9,000. 14 minus 5, 14 minus 5, the remaining 9,000 belongs to 12 months. The remaining 9,000, because it is written in the question, all items for which examiner is silent are assumed to accrue evenly over the year. So we need to apportion. But for this 5,000, examiner has openly told us, please listen, that this loan was generated. See, this loan was generated on 1st of April X8. This loan was generated on 1st of April X8. See, this is the evidence. Okay, so we need to cancel it out. Second thing. Now, this investment income includes the dividends. Now, a strip company paid dividend to shareholders. To shareholders means all shareholders of 18 million. See, this is P, this is S, this is P, this is S. Our holding is 85%, and S company has given total dividends of 18 million. So can you tell me how many dividends will come to our home? How many dividends will come to our home? Tell me. 18 million times 85%. 18 million times 85%. See, 18 million times 85% will come to parent companies 15,300. Yes, this 15,300 we have booked. This 15,300 we have booked in our investment income, which we need to cancel it out because of intercompany thing. Okay, so don't forget to remove this 15,15300 from investment income. One more dividend. Arch company paid a dividend of on 31st December X8 of 35 million. Now, see, we are P company and we have 35% shares of A company. Now you tell me how much total dividends are paid by Arch company. This is 35 million. How much we are going to receive? How much we are going to receive from this 35 million? Just multiply this 35,000 into 35%. Just multiply this 35,000 times 35%. I think the number is 12250. Okay, now look at me. Are we allowed to record this 12250 as an investment income? Are we allowed? Please look at me. Are we allowed to record this 12250 as an investment income in consolidated books? The answer is no. For associate, no, because we have already recorded associate share of profit. We have already recorded associate share of profit using PAT, using profit after tax of A company, and these dividends are already included. So we have to remove now. We have to remove from investment income. These dividends are already included. As part of associate share of profit. So now we need to remove this 12250 as well. So how many numbers we have to remove? See, from this we'll also remove, see, 12250, and how much for parent subsidiary dividend? I think 15,300. See, from 46,000 you have to remove 12250, 5,000 and 15,300. Okay, right? This is the intercompany cancellation. Cash marks, your concept must be cleared. Now, and can you tell me, S company has investment income of 2,000. We'll only simply do 9 upon 12 with this 2,000. Okay, no cancellation with this 2,000. Look at the screen. The S company's investment income, no need to cancel. Simply 9 upon 12. Simply 9 upon 12 with this S company's investment income. Okay, this is pure S company's normal income. But yes, S company is only with us for 9 months, so we need to apportion everything. Now, one more thing. Can you see some OCI? OCI, do you remember OCI, the revaluation gain? OCI gain on this is parent company's OCI and this is subsidiary company OCI. Now one thing comes in the mind of students, sir, parent company is with us, we are the owner of parent company, so we always take complete year things of parent company. In income statement we always take complete data of parent company, so complete. But see, this S company OCI, S company S company was taken over at 1st April, so only 9 months. S company was taken over on 1st April, so only 9 months. So a student may think to apportion. A student may think to apportion this 3000 by 9 upon 12. A student may think, a student may think to apportion this 3000 by 9 upon 12. But there is something written in note number 5 or note number 6. There is something written in note number 5 or 6. Wait, this is English. See, note number 6. Note all other comprehensive income means OCI. All OCI occurred after 1st April X8. After. So this revaluation gain belongs to pure 9 months. This revaluation gain of 3000 belongs to pure last 9 months, belongs to pure last 9 months. So no need to apportion, just take complete 2800 and complete 3000 in all calculation. Just take complete 2800 and complete 3000 in all calculation. Okay. Now there is one note number 5 which is related to requirement 2. Requirement number 2. There is one, what in the as we acquired the associate last year. You are not getting. Hope you remember the date I highlighted the date. We acquired the associate last year. We bought the shares of associate last year. So at the beginning of this year, associate must be in our SOFP. Associate carrying value must be in our SOFP in the last year balance sheet. See, note number 5 in Plank's consolidated statement of financial position at 31st December X7 last year, the carrying amount of Plank's investment in art was 145,000. You can just, for your easiness, you can assume it COI. This, assume it as a COI for associate. This is cost of investment for associate for your easiness. Okay. This was calculated using equity accounting. And this note number 5 is related to requirement number B. This is requirement number B. Okay. But let's forget it now. It's only 2 marks. See, requirement B is 2 marks. Requirement A is 18 marks. Be a good businessman. Be a good businessman during exams. Go for big marks. 18 marks is major. If you do mistake, even right now during this class, if you don't understand 2 marks, no issue. 18 marks is the real thing. You're not getting. If somebody has problem with these 2 marks, throw it away, this 2 marks. Give charity. I often say do charity of 2 marks. Do charity with examiner, no issue. You need 50 marks to clear. There are two columns only, pass fail. You have to cross the 50 marks barrier. That's it. So don't worry about 2 marks, 1 mark, no issue. As long as you cross the 50 marks border, you are excellent. You are the best. Not getting. So if somebody has difficulty in 2 marks, no issue at all. Try to do like this. Try to think like this. Okay. Now, finally, can anybody tell me, see, one more thing for income statement we need to calculate. That is associate share of profit. And for that, I will pick this A company's PAT. This A company PAT, that is 92570. 92570 multiply by 35%. 92570 multiply by 35%, multiply by 35%, multiply by 35%, 92570 multiply by 35%. Okay, and yes, I will also adjust the URP. I will also adjust the URP and associate share of profit. I taught you the 2100 thing, don't worry. Okay, so that was all. Wait, that was all the questions intro. Now I will shift my screen to Excel. Now I will shift my screen to Excel. Okay, right? So now the question, maybe I won't show you the question. I have the question with me. I have the question with me to write the figures, okay, to type the figures. But for you guys, I have already sent you the question. You can see that, or you can just trust on me, right? Okay, so let's move to the solution thing. Okay, dear students, dear students, dear students, uh, I have, just because as these are revision days, as these are revision days, I have written the unnecessary typing. I have already done. The objective of this session is not to teach you how to write the revenue REVE. No. How to type cost of sales. No, not this is not the objective. Okay. The objective is the revision. Okay. Giving you the concept. Now, if we start with revenue numbers, if we start with revenue, see, I for consolidated income statement, look at here. Look at here. First of all, there are three companies in this show: parent company, subsidiary, and associate. Parent, subsidiary, and associate. Parent, subsidiary, and associate. Is everything clear? Is the screen is perfect in front of you? Just one text. Is the screen is perfect? The Excel screen? Yes. Thank you. Now, so there are three companies: parent, subsidiary, and associate. Just ignore associate for few minutes, because we don't include associate in adding together, only parent and subsidiary. Okay, and with parent and subsidiary, parent company full year and subsidiary company only 9 months, because of acquisition date. Hope you remember. So now let me do sales. Let me calculate sales revenue. I have started calculated the revenue number equal to parent. See, parent company revenue is 705,000, 705,000 plus C, shift plus bracket open, subsidiary revenue is 218,000 times 9 upon 12. Now, boys and girls, instead of writing 9 upon 12, we can write 0.75. Instead of writing 9 upon 12, we can write 0.75. That's also fine. So let me do 0.75. See, 0.75. Bracket close. Now, do you remember the P2S sale? Do you remember the P2S sale of 39,000? Do you remember the P2S sale of 39,000? Yes or no? So we need to remove that P2S. We need to remove that P2S sale from sales and cost of sales. So let's subtract 39 million. Okay. So this is 8. See, this is 892. Let me wait. Let me increase the screen. Okay, and let me wait, switch off the camera. I'm switching off the camera for some time because I need to show you the full screen. Now, listen. So this is sales revenue. See, the formula is already there. Parent company sales plus subsidiary company sales times 9 upon 12. 9 upon 12 is 0.75. And then we remove how much? 39,000, that intercompany sales. Now, for cost of sales, working, what I'm doing, cost of sales, I'm doing working, separate working. I'm doing separate working, and still, listen, you guys are allowed to do it in the same format. You can do it in the main format as well. So now, cost of sales. What is parent company's cost of sales? Parent company's cost of sales is 320,000. Parent company's cost of sales is 320,000. C. 320,000 is the parent company's cost of sales. Subsidiary company cost of sales is 81,000. But you know, this, we have to apportion the subsidiary company cost of sales, that is 9 upon 12. So how we'll do it? That is 81,000 times 9 upon 12 or 0.75, whichever looks good to you. 81,000 times 9 upon 12. See, so this is, then after that we have to remove intercompany purchases. You know, 39,000 we remove. 39,000 we remove from sales. So obviously from cost of sales we need to remove the same amount. So 39,000. Okay, now hope you remember the URP thing. URP, we need to add URP. We need to add URP. How much was the URP? How much was the URP? I think URP was how much? Wait. 2250. Yes, URP was 2250. You can directly write it. You can directly write URP, or you can calculate it as well. See, 39,000. Sorry, 39,000 times how much? Into 30 upon 130 into shift 30 divided by 130. Okay, and times 1 upon 4 means times 0.25, times 0.25. Your, see this, I taught you URP calculation on the other screen. 2250 is the URP. Okay, now hope you remember the upward fair value adjustment. Hope you remember the upward fair value adjustment excess depreciation. Upward fair value adjustment excess depreciation. How to calculate? It's 8,000 divided by 3. Sorry, divided by 3. Okay, this is per year depreciation, times 9 months is 0.75. 9 months means 0.75. 2,000. Okay, right? So these are your cost of sales. These are your cost of sales. Okay, okay. Wait, something in the chat box. Okay, good. So let's calculate the cost of sales. It's 346,000. The cost of sales is 346,000, right? Now, what we have to do, we have to write this cost of sales in that column, but I'm giving you just 30 seconds just to analyze it. URP, see this URP formula. I've already taught you URP. Somebody is asking about the URP. URP I've already taught on the other page. For URP, listen, for URP, first calculate the total profit. For URP, first calculate the total profit and then multiply it by 1 upon 4, the unsold amount. Okay. Now, this 346,000 is your cost of sales. Let's take this cost of sales in the main format. Now let's connect it. Let's connect it 346,000. Okay. So see this. See the screen, please. Your sales is 829,500. Your cost of sales is 346,000. Your cost of sales is 346,000. Okay. So how we do it now? Let's calculate the gross profit. Let's calculate the gross profit. Wait. This is 483,500. Okay. Now, very simple. We need to adjust. You need to adjust associate share of profit. Associate share of profit. Wait. Let's do some working for this. Let's do some working for this. Wait. How to calculate associate share of profit? Boys and girls, how to calculate associate share of profit? Simple. You have to calculate it for the whole year, whole complete year. How? A company's profit, listen, A company's profit, A company's profit after tax multiplied by your holding percentage. A company's profit after tax multiplied by your holding percentage. Okay, you remember? A company's profit after tax multiplied by your holding percentage. What's the A company's profit after tax? It's 92570. Come on, quick. Let me write. It's 92750 times 35%, times how much percentage? 35%, 0.35 times 0.35. This is your 3246.25. 346.3. It's 92570. Sorry, my mistake. I've written wrong number. Wait. 92570. Sorry. Times how much? 0.35. Okay. 32999. Right. Now, how to add? How much was the URP? You can directly write the URP, no issue. How much was the URP adjustment? It was 2100. You remember I taught you 2100 adjustment. Okay, come on. Here you go. This is your associate share of profit. 302,999.5. 302,999.5 associate share of profit. Okay. Associate share of profit calculation I already taught you. I already taught you associate share profit calculation. In the case of associate, in this question, the total profit will be URP, the total profit, because all the goods are unsold. So complete profit is URP for associate, but in the end, you have to multiply it by 35%. Okay. Now, let's connect it with here, associate share of profit. Wait, equal, wait. Let me connect. This is, okay. This is associate share of profit. Now, for distribution cost, it's very simple. Distribution cost, parent company's complete share equal to how much? Parent companies is 58,000 and subsidiary companies 16,000 into 9 upon 12. So simply do it. Minus 58. I have to use negative 58,000. And if you multiply it 16,000 by 9 upon 12, so it's 9,000. Okay, so this becomes 67,000. And admin expenses now 92. And then 28,000 times 9 upon 12, that is 21,000. It's 113. Now, investment income. This is very important. Investment income. Please, now you don't need to sleep. I already told you, listen about the investment income. The investment income here is 46,000, right? Then minus, first do intercompany's cancellation. First do intercompany's calculation. Listen. 5,000 interest income we have to remove. 5,000 interest income we have to remove. Listen. Then I think you can directly calculate the dividends. No need to show dividend working. 5,000 is the interest income, and then dividends. Let's do dividend income. No problem. 18,000 subsidiary. 18,000 times 0.85. You remember subsidiary dividend. See, I have removed subsidiary dividend. Then associate dividend was, I think, 35,000. Associate dividend was, I think, 35,000 times how much? 30, wait. Yes, 35,000 times 35%. Bracket open. 35,000 times point, sorry, 0.35. See, we have removed associate dividends as well. I have done some mistake in the distribution cost. I'll correct it. Wait, I'll correct it. I've done a little mistake, I think. Yes, in distribution cost. 58 plus 12 is 70. We'll correct it. Don't worry. I've seen. Then see, these all intercompanies cancellation is in front of you. And finally we have to add. The subsidiary part. Did you see the subsidiary? I think there was some investment income in the books of subsidiary. There was some investment income in the books of subsidiary. You remember? There was some investment income in the books of subsidiary, 2,000. Yes, we'll take 9 upon 12. We'll take 9 upon 12 of that as well. So 2,000 into 9 upon 12 means 0.75. 9 upon 12 means 0.75. Sorry. Here you go. Now, I'm not pressing enter right now. You first see this formula. See, 46,000. I just removed the interest income, intercompany interest income. Then both dividends I have removed. Both dividends I have removed. Right? And then I have added 75%. I have added 75% of subsidiary investment income. It's 14950. It's 14950. Okay. Let me correct the distribution cost. There is a little error. Yes. 58,000 minus how much? It was 12,000. Sorry. Yes. Now the distribution cost is correct. You can check. There was a little error. There was a little error in distribution cost. One student is asking about the 2,000 point. Wait, let me show you. I have 2,000 as well. See this. Look at here. See, there is, I have shown you the question. See, there is an investment income. See, there is an investment income of 2,000 in strip company's books. So definitely we will apportion it 9 months, only 9 months adding together. I hope the guy who asked the question, he got the answer. Okay. Okay. Now then finance cost. See, parent company's finance cost is 12,000. Parent company's finance cost is 12,000 and S company's finance cost is 14,000. This is for the whole year. Wait, but there is one 5,000 intercompany already included in it. There is one 5,000 intercompany already included in it, and that we need to remove it. And that 5,000 belongs to pure 9 months. So without apportionment, remove that 5,000. So if you remove 5,000 from 14,000, then remaining 9,000 belongs to whole year. Remaining 9,000 finance cost of S company belongs to whole year, and then you have to apportion that 9,000 times 9 upon 12. 9,000 times 9 upon 12. So repeat, parent company's 12,000 finance cost will go as it is, and subsidiary companies 14,000 finance cost. First we'll remove the intercompany cancellation of 5,000, and then we will do apportionment of 9,000 times 9 upon 12. Okay, let's do it, no issue. Equal minus how much? 12,000 for parent company, then minus brackets how much? I think 14 minus 5, 14 minus 5, make it 9,000 direct, times 9 upon 12 means 0.75. 9 upon 12 means 0.75. Okay, I'm using negative signs because I need finance cost as a negative number. I want finance cost as a negative number, that's why. Okay, so what's the answer? It's 18750. It's 18750. Let me show you the formula. See, 18750. Okay, yes, 5,000 was for 9 months. 5,000 was for 9 months. So I simply removed it. 5,000. That is intercompany. And then that 9,000 was for 12 months, was complete for 12 months. Okay. And this I have issue with the solution as well. I have this conflict with the solution as well. Now let's calculate, let's simply calculate the profit before tax. Let's simply calculate the profit before tax from GP. Wait, see, this is GP, and this is GP, and we have to add all these numbers. See, this is GP and we have to add all these numbers. So 326 something, right? Now income tax is very simple. Parent company's income tax complete, and subsidiary parent company's complete income tax. This is how much? 51,500, 51,500. And then subsidiary companies 9 upon 12. So subsidiary companies income tax is 15,000 times 9 upon 12 means 0.75. See, this is your profit for the year. Can you see the text? Okay, so this is the complete. Okay, Now we have done the now let's add OCI. How we do it? Listen, the way we are adding together the whole parent and subsidiary income statement, the way we add together the whole parent and subsidiary data, we do the same for OCI. We do the same for OCI. Now what's the OCI? What's the OCI for parent company? It's 2800. What's the OCI for parent company? It's 2800. And what's the OCI? Look at here. What's the OCI? What's the OCI? What's the OCI for subsidiary? It's 3000 and it's already ready made for last 9 months. It's already ready made for last 9 months. So simply what we'll do, simply we'll add 3000 in it. We'll add see this, 2800 plus 3000, 2800 plus 3000. Okay. So this is 5800. Now let's calculate total comprehensive income. Let's calculate total comprehensive income. Total comprehensive income is profit after tax plus OCI. Profit after tax plus OCI. Here you go. This is your total comprehensive income. Now we have done the income statement complete, but hope you remember, now you have to write 3 lines 2 times. Now you have to write 3 lines, the profit distributable lines 2 times. First of all, you have to do it for profit. First of all, you have to do it for profit. Okay. First of all, you have to do it for profit, and then you have to show the breakup for total comprehensive income. I'm giving you 30 seconds to 1 minute to analyze it. 30 seconds to or 1 minute to analyze it. Okay. Okay. One question somebody asked, what about the fair value adjustment? Fair value adjustment. It's already cancelled out. It's already cancelled out. Because fair value adjustment is the acquisition date thing. It never comes in income statement. Fair value adjustment never comes in income statement. Don't forget. Yes, the depreciation we adjust. Now we have to calculate, listen, please, little energy. We have to calculate NCI for income statement. We have to calculate in NCI for income statement using profit, okay. Let's start. See, look at here. Do you have, please, we need energy now. As income statement is a for the year thing, as income statement is a for the year thing, that's why the income statement NCI is also for the year thing. So subsidiary company was with us for only 9 months. Subsidiary company was with us for only how many months? 9 months. Okay. So what we'll do, we'll simply apportion it. We'll simply apportion the S company's profit after tax. S company's profit after tax times 9 upon 12. So what is the S company's profit after tax? It's 66,000. Let's do it. 66,000 times 9 upon 12 is simply 0.75. Okay. So this is your apportioned profit. Now, few things market which you need to adjust. First of all, just a reminder, was there any S2P sale? Was there any S2P sale in this question? No. Was there any full goodwill method impairment? No. Was there any excess depreciation? Yes. In this question, there was an excess depreciation which we have to adjust it. These 3 are the normal checkpoints. Number 1, any S2P sale? No. Any full goodwill method impairment? No. Number 3, any excess depreciation? Yes. Upward fair value adjustment, excess depreciation was there. Upward fair value adjustment, excess depreciation was there. So yes, we need to subtract it, and that was 2000. That was 2000, my dear. I calculated it for you. Okay, so here you have the profit. Okay, see the adjusted number is the adjust oh sorry, the adjusted number is, sorry, wait, 47,500. Okay, so this is the adjusted as company's profit after tax. First of all I'm calculating NCI using using profit. NCI using profit. C, what is the formula? Simply this 47,500. Please look at me. This 47,500 times your holding percentage, times NCI holding percentage. And in this question, our holding percentage was 85%. Our holding percentage was 85%. So NCI holding is 15%. So simply see 47,500, highlight it, times 0.15 times 0.15. Here you go, you have 7125. You have 7125 as an NCI. You have 7125 as an NCI. This NCI is calculated using the profit number. Okay, now hope you have done something for F7, something in F7. Now NCI for total comprehensive income. This is one more thing. See, in your exam kit, you might have done the questions like what's the name, prodigal. These things already you did in prodigal and all these. Now this is NCI for profit, this is NCI for profit. Now NCI for total comprehensive income. How do we calculate? Just a final account thing. How do we calculate total comprehensive income? How do we calculate total comprehensive income? By adding OCI in profit, by adding OCI in profit after tax. So see, this is 7125. This 7125 is calculated using profit after tax. Now add OCI share, add OCI share of S company. I think OCI share was 3000. S company, in S companies, in S companies SOCI, there was an OCI, of 3000. Hope you see the question. Wait, let me show you the question. See this. Boys and girls, please, little energy is needed. There is an OCI of 3000. There is an OCI of 3000 in S companies books, okay. And this OCI purely relates to last 9 months. Okay, so no need to apportion it, please, no need to apportion it. Wait, so see, this is 3000, directly 3000 times NCI holding percentage is 15%, times NCI holding percentage is 15%. 3000 times NCI holding percentage is 15%. So let's calculate this number as well. See, this is 7575 and this is 7125. Okay, NCI using profit and NCI using total comprehensive income. Did you understand this calculation? Please reply on the chat box. All of you, please reply on the chat box. Did you understand this NCI thing? Did you understand this NCI thing? Please reply. Yes, OCI share, I can show you this. See, Now let's write those three lines for you. Let's write those three lines. See, these are the three lines, if you remember. So first of all we'll write these three lines for profit. See, total profit attributable to, see, look at here, we'll write the total profit, we'll copy paste the total profit first. See, what's the total profit? What's the total profit? This 264249, 264249, 264249 is the total profit. See, I have written here 264249 is the total profit I have written. Now what is the NCI share? What is the NCI share of profit? What's the NCI share of profit? What's the NCI share of profit? It's 7125. NCI share is 7125. Can you see? Now you have to calculate the parent company. Simple, this minus this. See this. Now let's do the same thing for total comprehensive income. How much is the, wait, what's the total comprehensive income for the whole group? It's 270049.5. Okay, right? And what's the NCI share? What's the NCI share of total comprehensive income? We have already calculated it. We have already calculated it. Wait, this is the NCI share of total comprehensive income. See, okay. Now let's see the share of parent company. This minus this. Okay, here you go. Your 18 marks done. 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 Did you understood the ending things? Please tell me. Reply on the chat box. Reply on the chat box. Did you understand these ending things? Please, all of you reply. Now there was one requirement B as well. Requirement B. It's a short requirement and we can do it. And few people are asking one question. I'll answer that. The question is, wait, sir, why? There is a question. Let me clarify it. Why associate share of dividends from associate? Why dividends from associate are not deducted from associate share of profit? Why? Because we have to at least record one time as an income. That's our income. Yes, we are investors in associate company. We are investors in associate company. So that dividend is your investment income. And at least one time you have to record it. Yes, at least one time. And it is already included in associate share of profit. So let it be. Let it remain in the associate share of profit because it's your right. One time at least you can book, but you cannot book it two times. How? It may come in your books two times because already parent company has already recorded in investment income. parent company has already recorded that dividend and investment income individual books, and it is also included in associate share of profit. Now there are two places. One is investment income, parent companies in one time it has been added in parent company's investment income, and second time it is already included in associate share of profit. So these are two times. So just simply remove one time, not two time, because at least one time is all right. Did you understand? No, we can't do either way. Only it's must that you have to remove from investment income, because it is already included in associate share of it. This is not a choice, please. This is IFRS. This is IFRS. It's like a law which you have to follow. Now, the next requirement. See this. This is the question. Now the last requirement. Calculate the carrying value. Read the requirement. The requirement is in front of you. Calculate the carrying amount of investment in Arch company in the consolidated statement. See, this requirement relates to balance sheet. Calculate the carrying amount of the investment in Arch company in the consolidated statement of financial position as at 31st December 08. Now wait, I can't shift my screen to iPad now because it will consume my time. But today, I taught you guys. Today I taught you guys. Wait. Today I taught you guys how to calculate carrying value of investment. Total page I showed you. Hope you remember how to calculate carrying value of investment in associate. And after the class, I'll send the pic. That's my duty. I'll send you the pic of that page. So what things come? See, COI, cost of investment. First we write COI. Look at me, you will understand. COI, then post profit share, post profit multiply by your holding percentage. Okay, two things. Third, deduct any impairment if any. In this question there is no impairment. In this question there is no impairment of associate. So forgot it. Now the fourth thing, oh God, please help these kids. Now the fourth thing is remove or deduct dividends from associate. Dividends you receive from associate. Hope you remember. And the fifth thing is, if there is a P to A sale, P2A, then remove the URP share as well. URP multiply by your holding percentage share in it also. This I taught you. Okay, so I repeat, first of all you'll write COI, then you will add post profit multiply by your holding percentage, then you deduct impairment from associate. Okay, then number four, listen, look at here. Number 4, then you deduct dividends from associate. Number 5, if is there any P to A sale, then you remove the URP thing as well. In this question there are everything except for impairment. Okay, now wait, just read the note number 5. I've just stopped at note number 5. Just read the note number 5. Just read the note number 5 thing. This note. See, can you see this? Already the COI, just think, already the COI at the beginning of the year was 145,000. Already the carrying value of investment in associate, at the beginning of the year was 145,000. Now just adjust this year's number, you will get the answer. Okay, so I'm moving on my screen now. Yes, 145,000 is should be taken as COI for your easiness. Let's do it. Let's do it, boys and girls, please. See, this is carrying value of investment in associate at 31st December 07 was 145,000. You can assume it as COI. Okay, you can assume it as COI. Now then, share of post profit. Share of post profit. You remember our profit was 92750. Our profit in this question was 92750, and you have to multiply it with your holding is 0.35. Okay, 92750 multiplied by 0.35. Let me apply the formula as well. 92750 times 0.35. Okay. Oh, sorry, I did again 92570. It was 925. Sorry, my mistake. It was 92. Wait. Oh, sorry. Okay. Sorry, let me change. 92570. Not okay. Now, less dividend paid. There is no impairment in this question, so forget it. Dividend was, I think, 122. How much? 12250. Dividends from associate was 12250 minus 12250. And URP adjustment was 2100. URP adjustment P2A. Let me write here. URP adjustment here P2. Sorry. P2A. Okay. Now, what should be the carrying value of investment in associate? Okay. So that's the end. That's the end of this question. That's the end of this question. 163. Okay, 050 or 049.5. Okay. Done. Wait 2 minutes. Wait 2 minutes. Wait 2 minutes. Relax 2 minutes. I'll teach you. I'm not going to teach you one more new question. That question is not difficult. That's easy. You can do it yourself. I'm going to revise one topic, that is disposal. You know, in our F7 course, we have not only we have the buying of running business, but also the selling of running business. So I'll make you revise that disposal topic. I'll make you revise the disposal topic. Don't worry. Just wait 2 minutes. 2 minutes. Just wait 1 minute. I'll share the Excel file as well. Don't worry, don't worry, don't worry. Now, the topic is disposals. In this F7 course, not only we have in this F7 course, not only, please, last 10 minutes I'll take. In this F7 course, not only we have the buying of running business, but also the disposal of running business. Okay, right? So for example, look at here. I'll make you revise. For example, you bought the running business on 1st of January 2016. Okay, so these are routine things which you already know, that on acquisition date you will compute goodwill. On acquisition date you will compute goodwill and all. You will compute goodwill and all. That's routine thing. Okay, you have to do it. Now, for example, the case number one. Case number one, in the question it is written that you sold on the very last day, you sold all the shares, you bought the 80% shares. For example, you had 80% holding, you had 80% holding of that company, and you sold all the holding one shot on 31st December 2019, the last day, the very last day, on the morning or very last day of the year end, the reporting date. Okay, now just think, when you sell a single asset, for example, you sell a plant, you sell a chair or anything, you compute gain or loss on disposal. So now as you have sold the running business, obviously you have to compute gain or loss on disposal. Now, there are two methods of calculating gain or loss on disposal. Some students do it through statements, and some students do it through entry. I'll tell you both things, which whatever you like it, do it. Listen, first of all, see, you will write disposal proceed. Obviously, you have sold the running business, you got the money. You sold the running business and you got the money. So you have disposal proceed, DP. And obviously, this DP, as you had 80% shares, as you had 80% shares of that company, so that means you sold 80% of the holding, so that this disposal proceed is equal to 80%. This disposal proceed is equal to 80%. Okay, now what you will do, as you sold the running business, that means you sold all the net assets gone. So see, look at me, less fair value of net assets of S company, add, see, I have changed the color, add disposal date, fair value of net assets of S company as disposal date, this fair value, see, this net asset packet you have to use, the disposal date net asset packet. Now I repeat, for disposal gain or loss calculation, you have to use the disposal date net assets packet, don't forget it. So fair value of net assets of S company at disposal date, this number. And then now think, as you sold, just think, as you sold the running business, look at here, as you sold the running business, you have sold the goodwill as well. You have running businesses are always sold with goodwill. Running businesses are always sold with goodwill. So you have also sold the goodwill. So you have also you have to write goodwill at disposal date. Okay, all the data at disposal date. So this thing and this thing we have added, this thing and this thing we have added. Now one great mathematical issue. See, this net asset is complete and this goodwill is also complete. Net asset and goodwill is also complete. So they both are 100%. They both are 100%. But look at here. This is 80%. This disposal proceed is 80% and the net assets and goodwill is total complete. So now we need to remove NCI from this total. We need to remove NCI from this total. Read the English, please. Read the English. See, less NCI. See, NCI at dash date. Less NCI at disposal date. Don't forget this thing. Okay. And when you remove this 20% NCI, see, the final number is automatically 80%. This final number is automatically 80%. Use your brain. Use your brain if you have some. If you have some. Okay. Now, if you get deduct this from this, if you get a positive number, it's a gain. If you get a negative number, it's a loss. Gain. I hope you understood it. I hope you understood it. Now, if you want to make it through entry, listen, in my classes, I often say my students that wait, now you have to break the building of consolidation because you sold the running business. Few years back, you acquired the running business. Few years back, you bought the running business and now you sold it. So now you have to break the building of consolidation. So in our class, normally I say in my class that building breaking entry, consolidation building breaking entry. Okay, how we make it? See, this way. Wait. You sold the company, you got the cash. You sold the company, you got the cash. So debit bank, you got the proceed, debit bank. Okay, now just think, 1 second before the disposal, this company was attached to us. 1 second before the disposal, this company was added with us. Yes, and now we sold it, so we said goodbye, bye. So S companies net assets at disposal date, at disposal, just simply remove it. Okay, again, as we sold the running business, we sold the goodwill as well. We said bye. So goodwill also credit. Now, as we have broken the building, so now that's the end of NCI as well. No more NCI will be recorded in our books because this is the end of consolidation. This is not the birth of consolidation, this is the death of consolidation. Okay, and NCI is calculated using equity. The nature of NCI is equity. So when you remove NCI, it will go on the debit side, NCI debit. And now finally, let me change the color. Now finally, if you get a balancing number here, see, if you get a balancing number here, it will be gain on disposal. See, I've changed the color. And if you get a balancing number here, this will be loss on disposal, my dear boys and girls. Either you get gain or you get loss, or not get lost, or you get loss on disposal. Okay, so this is the entry. Few students like entry and few students like statement. I personally like double entry. For this topic, I personally like double entry, but whatever you like it, you can do it. Whatever you like it, you can do it. Okay, now one golden lines and very important thing. Listen, as look at me, please. Few minutes of concentration, please. As on the last day, wait, as on the morning of 31st December 2019, on the morning of 31st December 2019, you sold your running business. So in the evening time, at the end of the year, you don't have, you don't have any control of this company. So now at the year end, no more adding together in the balance sheet, no more assets and liabilities adding together in the balance sheet, no more adding together in the balance sheet, assets and liability side, no adding together, strictly no, because you lost the control on the last day. You lost the control on the last day morning. Okay, and balance sheet is always as at, balance sheet is always as at, so you no longer have control with that in that company. But one thing which is very important, look at here. From this date, please boys and girls, from this date to this date, from, see this line, this date to this date, this was your time, this was your controlling time, you were the owner, between these time. From the acquisition date to disposal date, that was your time, so listen my words, you must add this 15, see this 15,000 S company's post retained earnings share in consolidated retained earnings. You must add this 15,000, you must add this S company's post retained earning in consolidated reserve. Okay, see, I've written here. Don't forget to add. This is the mistake in the examiner report. Examiner has also written. All of you listen. I forgot to tell you in the beginning. Do read. All of you, please. All of you must read the examiner reports of recent attempt, last 2 attempts at least, examiner reports. In that way, you can identify the mistakes done by students. Don't forget to add S companies post retained earning from acquisition date to disposal date, in consolidated retained earning. Okay. Now I need to teach you one last case, one extra case. I know you are tired and I'm also tired. Please, because I'm constantly speaking. And in my physical class, I use very good quality mics, but right now here there are no mics. So it is hurting. Now, listen. For example, look at here. Your acquisition date is 1st January 2016, and this is the data of your acquisition date. Your acquisition date net asset is 10,000. So simply you will be calculating goodwill at acquisition date. Goodwill at acquisition date. Now, in the question, your reporting date is 31st December 2019. In the question, your reporting date is 31st December 2019. Please look at here. But the disposal date, is 30th June 2019. Okay. But the disposal date is 30th June 2019. Look at here. So now, by hook or by crook, you need to calculate net assets at this date. You need to calculate net assets of S company at this disposal date. Okay. So look at here. For example, examiner, see, this is written. For example, examiner has given you the profit after tax of this last year. For example, examiner has given you the profit after tax, the PAT. The PAT of last year is 10,000. For example, the PAT, profit after tax, for the last whole year is 10,000. So what you will do, you will apportion it. You will apportion this profit. See, this is the whole year profit. See, this 10,000 is the whole year profit. You apportion it with 6 upon 12. So this will be 5,000 and this will be 5,000. Now use your brain. You are on the end of F7, please. You are on the end of F7 now. This closing retained earning includes this 5,000. This closing retained earning, this 5,000 profit is already added. This 5,000 profit is already added in closing retained earning, and now you have to go reverse. You have to go reverse. So 25 minus 5, this date retained earning will be 20,000, and share capital is same, copy paste. So your disposal date net assets is 25,000. I know this is 30, but this is 25. So this number is very relevant for you. Your disposal date net assets is 25,000. Your disposal date net asset is 25,000. This is last year PAT. Last year PAT is given. Last year profit after tax is given. Now, in this question, just 2 minutes. Sorry, I've taken a lot of time. I'm really sorry. In this question, this 25,000 will be used in this gain or loss on disposal working. Okay. And now, can anybody tell me what is the S company's post retained earning in this question to be included? What is the S company's post retained earning to be included in consolidated reserve? Very good, excellent. One student told the S company's post retained earning. Which post retained earning you have to include? From your acquisition date to your disposal date. See, this is 25 minus 10 is 15. Okay, 25 minus 10 is 15,000. This is the S company's post retained earning, which you have to include in consolidated reserve working. Okay, so now I'm tired. This throat is not working now. So I hope you understood it. I hope you understood something. Our tomorrow's agenda is very important. That is ratios. Ratio is one of the most technical topic for students. Ratio analysis is one of the most technical. F7 ratio is not easy. I always say it openly. The only area which is technical, which is little difficult in F7 is ratios. Don't think it's very easy. Okay, so now let's meet tomorrow. I'll send you the link before the class. Same 5 p.m. I'll send you the link. Okay, do attend, don't miss the class. It will be useful. I've arranged many points for you. Okay, right? Take care. Bye bye. Allah Hafiz.